Thank you. Please take your seats. May I request the chairperson, CA Albhuda Jyoti, to kindly welcome the gathering.
Distinguished speakers of the day, respected past chairman, my dear members, a very warm good morning to all. It gives me immense pleasure to welcome you to the second day of our National Conference on Direct Taxes, jointly organized by the Kozhikode branch of ICAI and the Direct Tax Committee of ICAI. The overwhelming response and active participation witnessed yesterday clearly reflected the commitment of our members towards continuous professional learning. The insightful sessions, thought-provoking discussions, and valuable interactions made the first day a memorable and enriching experience for all of us. Today, we have an equally exciting and knowledge-packed lineup of technical sessions led by some of the most respected experts in the profession. We begin the day with a highly relevant session on direct tax reforms, navigating the changing landscape of statutory updates, policy shifts, and systematic overhauls to be handled by the eminent faculty, CA Rishabh Agarwal from 9:30 to 11:30 a.m. In an era of rapid legislative and policy changes, this session promises to provide valuable insights to the evolving direct tax framework. The second session will feature CA V. Ramnath, who will guide us through the important topic of exemptions under the Income Tax Act 2025 other than NPOs. His vast practical experience and subject expertise will undoubtedly make the session highly beneficial for all participants. Post-lunch, we are privileged to have CA Gopal Krishna Raju and addressing us on the critical areas of capital gains and TDS provisions. Given the practical significance and frequent changes in these areas, I am sure this session will provide valuable takeaways for our professional practice. On behalf of the Kozhikode branch of ICAI, I extend a warm welcome to all our dignitaries, faculty members, delegates, and participants. I wish you a day filled with learning, interaction, and professional enrichment. Thank you, and wish you all a productive and rewarding day 2 of National Conference. Thank you all.
Thank you, ma'am. The evolving direct tax landscape requires professionals to understand not only what has changed in the law, but also why those changes have been introduced. May I invite CA Rishabh Agarwal to address the gathering. Sir.
Is it okay if I can? Anything is fine. Thank you. Good morning to all, and thank you to Kozhikode branch for the invitation. I hope I'm audible till the back. Sir, but the point is I don't want to be audible till the back, so please come in the front. That's fine, thank you. Yeah. And I would like to thank the chairperson over here for a wonderful hospitality and welcome and the introduction as well. This is my third branch in Kerala that I am covering with the session. I've already been to Ernakulam and to Thrissur. So this was my first time over here for any purpose, be it session or be it for leisure. I'm sad that I'm not getting enough time to be here in the city, but that gives me an opportunity to come back the next time, right? So with this, my topic for today is a bit different from the others that you've been seeing yesterday and that you will see today as well, right? So, but this topic becomes of very importance when you are, especially in this part of the country, dealing with non-resident individuals and dealing with cross-border payments. So I'll quickly take questions. So this session is a bit different because usually the audience is asking faculty the questions. It will be reversed today. I will be asking you questions. So please ensure that you participate. There is no right or wrong, right? Either you can be more appropriate or less appropriate. That is the only downside. But I think participation is the must. Are you all okay with the participation? Anyone who says no can raise the hand. This is the first question. Perfectly fine. Right. So what I'm going to take today is on the withholding tax part. So we will see both the domestic tax legislation. I have put the sections from the Income Tax Act 2025 for the benefit of all members. I have also mentioned the Income Tax Act 1961 sections. But what we are concerned with is the Income Tax Act 2025 sections. How many of you remember sections by now for 2025 Act? Even I don't. So we will all see on the screen whenever it is about the section number, but we will not see towards the screen whenever it is about the concept, because the concept remains principally the same, right? And I am restricting my comment as to today's discussion and not in general towards the Income Tax Act 1961 versus the Income Tax Act 2025. So only for today's discussion, I am reserving this comment or my session's discussion that principally it remains the same. Section numbers have changed, the presentation has changed, but the rates for withholding tax or deducting tax as TDS is the same. The issues are still the same, and also the settled positions are also the same, right? So I will quickly take again questions as to how many of you are in practice here? Almost all. And what about the others? People who have not raised hand who are not in practice. So we can assume everyone is in practice. What do you do? Manager. Managing what? Audits. Okay. Right. So it becomes more pertinent or more important from the practitioner's perspective. So when we talk about practitioners, again, quickly with a raise of hand, how many of you have encountered cross-border payments? So payments going from India to some other country, or the reverse, payments coming to India from any other jurisdiction. Perfect. So to term it, whenever we'll have a payment going from India, we'll call it outbound from an India perspective, and whenever we have a payment or money coming back to India, we'll call it inbound from an India perspective, right? This is the basic terminology that we'll use. When does a liability or an obligation to deduct tax arise? When does a liability to deduct tax or an obligation to deduct tax arise? In an inbound transaction or in an outbound transaction? Outbound. Why? Because the payer has to deduct the tax. So when we have an Indian payer who is making a cross-border transaction or a cross-border payment, that is where he will have to deduct tax. Are we all on the same page? Does anyone feel that during an inbound transaction we need to deduct tax? Everyone says no. If at all there is any withholding tax or TDS, it will be taken care by the payer in the foreign jurisdiction, right? We need to be worried about how to take credit for that, because the Indian recipient's tax has been deducted in a foreign country. We will get credit while we are filing our own income tax return or corporate tax return whatsoever. Are we all again on the same page? Do we disagree? Perfect. Right. So I will cover both the sides, that whenever we are making an outbound transaction, so what are the issues, at what rate you need to deduct tax, and whether you need to deduct tax as per the Income Tax Act 2025 or as per the Double Tax Avoidance Agreement. What is a double tax avoidance agreement? I'll tell you. So basically two friends were fighting. So two neighbors are there. I will give you a short story over here. There are two neighbors, me and my neighbor. I have grown a tree in my courtyard or in my backyard, right? But that tree is leaning over the fence into my neighbor's property also. Then I told my neighbor, sir, it is very difficult for me to take care of the fruits that are on your side because I cannot reach to them. Right? So is it okay for you that you take care of them, you clean them, put pesticide and make sure that the fruit is not spoiled. So whenever, whatever fruits will fall on your side, you can keep 20% of those fruits and give me 80%. Right? So what happened over here? Will we fight initially that all of this is my fruit because the tree is on my land? I have grown the tree, I have watered it, I have made it from a sapling to a tree. Do I have the right to bear all the fruits, even though the fruits that are falling into someone else's backyard? Yes, no, maybe. Forget about tax, think about fruits. Do I have the right to get that fruit which is on my neighbor's territory also? Do I have the full right to get that? I should get all the fruits, I should give him something because he is also taking care of that tree now. I should give him also something, right? So that is the concept of source and residence. So whenever we are seeing or whenever we are looking at a double tax avoidance agreement or a DTA, we look from the perspective that this income should be or can be taxed in the source country, right? These are the terms being used in a DTA, that the income can be taxed in a source country, but you get a credit. So similarly, when there is an Indian inbound transaction, so an Indian recipient getting money from outside for a service or for royalties or for interest or for anything else, and the tax has been deducted. So the tax has been deducted at source, TDS, tax deducted at source. Source is the country who is making the payment, and we get a credit in the residence country. So for an inbound transaction, the residence become India, source becomes the payer's jurisdiction. For an outbound transaction, source becomes India and the residence becomes the recipient's jurisdiction. Are we all on the same page again? Perfect. Right? So now source and residence is also clear. We will not worry so much about the technical terms. We will try and understand the concept as to what is happening when we are deducting tax. Right? So from an Indian income tax perspective, outbound transactions again, either I can deduct tax at the rate mentioned in the Income Tax Act 2025, or I can deduct the tax at the rate mentioned in the double tax avoidance agreement of any other jurisdiction. So basically, if I'm making payment from India to UAE, I will see India-UAE tax treaty or DTAA. If I'm making payment from India to US, I will see the India-US tax treaty. The rule of thumb is I need to do what is the most beneficial. However, there are checkpoints as to whenever I want to use a tax treaty, I need to collect some documents. Right? We'll see those list of documents as well, because what happens that the payer is a businessman. Right? We are the advisors. The recipient is also a businessman having their own set of advisors. The recipient says, please don't deduct tax. As per the treaty, you need to deduct only 5%, 7%, 10%, whatsoever. But we say, no. It is our liability to deduct tax, and if there is any penalty, who will pay? The payer or the recipient? TDS penalties, who pays? Payer. Whose default it is? Who will be considered assessee in default? Payer. So the payer becomes very cautious about this fact and says, no, sir, I will not give you treaty benefit. I will do as per what my Income Tax Act says. Right? And what happens at the end of the day? Deal falls off. Right? So we need to be very clear as to when a treaty benefit can be availed and when not a treaty benefit can be availed, and what documents are essential to get a treaty benefit. Right? See, from a tax authority perspective, that you need to give the tax authority a chance at least to check whether you have rightly given a tax treaty benefit or not. To give them a chance, you need to give them some documents. Right? So that list of documents also we will see. But purely from a practitioner's perspective, we go and always see first the Income Tax Act, then go and see the relevant tax treaty, if at all there is any relief. If there is any relief, you ask for the specific documents to give that relief or to so that the recipient can avail the relief. So far, so good? Doubts? No doubts. Perfectly fine. Right? I'll quickly again take, so I have a set of issues that I will discuss. So basically, certain payments that are being made by Indian residents to non-residents, so like rent, sale of property by NRI, these are common issues that we see day in, day out. But I want to hear from you what sort of payments that you see in a cross-border scenario to all the practitioners who raise their hands. If you could illustrate those for me, we will try and club them and cover it during the deliberation in the next 1.5 hour while we discuss. So what are the cross-border payments that you see where you feel that you need more clarity as to what needs to be done? Sir, can we have a mic or something, because it's not audible to me if someone is speaking. Cross-border payment examples that you feel need more clarity. Anyone? Sir? So sale of foreign shares. So that is an inbound transaction. Sale of foreign shares by an Indian resident. We'll park it, sir. Anything else? Sir, please. Because the idea is not to come and serve you the food which I want to serve. The
Money
idea
is
is also
given by
Sorry, sir.
parents to son. This fund is transferred abroad.
Can you go again, sir? I didn't.
Money
hear
is transferred by by parents to son.
Parents
This
to
fund
son.
is transferred abroad.
So parents are in India and son is abroad.
Yeah.
That is a simple gift, sir. That is okay. Okay. We'll cover that also, sir. So transfer for maintenance of self or relatives. Right.
So payment to consultants outside India.
Sorry, sir.
Payment to consultants.
Sir, that is covered, but perfectly fine. Payment to consultants outside India. Sir, we'll divide into two parts. Payment to consultant outside India for job done outside India, and payment to consultant outside India for a job done in India or for business in India. We'll cover both. Right. Anyone else? ESOPs. I'll briefly touch on that, sir. So foreign ESOPs for Indian employees. Yes.
Hello. One of my client who is a resident in India, he want to transfer to fund to UAE for starting a business.
Yeah.
Around once a year.
Send, sir. No problem. Right. So foreign investments. So or opening up a foreign business. There's another request.
There are payments which are made through credit cards, etc.
Yes, sir.
So, especially related to software and all.
Yes, sir.
So, how do we ensure deduction of tax sets also?
You cannot do anything, sir. We are only human. We are not God. So things where you do not have a check and balance. We are consultants. You give us garbage, we will give out garbage. We are like computers again, right?
So, the deductor is at risk, right?
It will always be at risk. If at all there is a transaction. So I'll tell you the tax authorities view over here. Why I'm answering this right now, because it can be finished in 30 seconds. So tax authorities simply say that you are deliberately making a payment through the credit card, even though you have made from the banking channel, just to avoid that check and balance. Right? That is the view of the tax authority. So if at all you can make a payment from banking channel and you have a TDS obligation or a withholding tax obligation, doesn't matter the mode of payment that you're making, because there is no check and balance. You still become an SSC in default, because the idea is not based as to which channel or medium of payment you are using. The idea is based, do you have a liability to deduct tax? Because the foreign recipient has income accruing arising in India. Right? So that is the idea. So if
One common payment is software, for use of software.
So that is okay, sir. Software, I'll discuss TDS implication. Anyone else? Okay. So I will summarize them, and almost 80% of them are already covered with the issues that I have brought in, right? So before we actually go into the, I would say, TDS obligations or withholding tax obligations, there are 3 sections that are very important, which we tend to ignore, right? And the good part is those section numbers remain the same whether in 1961 or 2025. Right? How is that possible? Because those are the initial sections. So first we'll talk about residential status. How many types of residential statuses do we have in India? Types, just categories. Sir. Resident. Resident and ordinary resident. Resident and not ordinary resident. And third one? Non-resident. 3 categories, right? Why are we trying to see these categories? We are trying to see these categories because what income is taxable in India is dependent upon what is your residential status. For a resident, a global income is taxable. If I am a resident in India, does it matter where I am earning income, how I am earning income, whether the income is legal or illegal? If I say I have received 10 crore rupees for kidnapping, Does it mean since it's an illegal activity, I will not pay tax on it? I will pay tax. If I say I have taken a bribe, does it mean I don't pay tax on it? I will pay tax on it, right? So for a resident, it really doesn't matter whether where I have earned the income, where I have received the income. If I say I'm a resident in India, I have a US bank account. Can I receive funds in my US bank account and escape that income from taxation? No. So it really doesn't matter for a resident that where I have received the income, where I have earned the income, where the income has accrued, and whether that income is legal, illegal, illicit, or legit, doesn't matter, it is taxable in India. So rule of thumb, resident is liable to tax on its global income, irrespective of the country of receipt, irrespective of the country of accrual, irrespective of the country of earning that income, right? Similarly, when we talk about a non-resident, so this global income taxation I told for resident and ordinary resident. When I talk about non-resident, it clearly says, or section 5 clearly says that only income accruing arising in India, deemed to accrue arise in India, or received or deemed to be received in India. Why so? Because if India wants to get a right of taxation from a non-resident, it needs to prove some connection. If there is no connection to India, how can India prove that or get the right of taxation or claim the right of taxation? Do we all agree? That is the reason that when a non-resident is selling shares of an Indian company, India is still trying to take tax on that sale. Right? If a non-resident is selling shares of an Indian company, India is still trying to take tax, tax that sale or that capital gain. Why? Because there is a connection. This connection in technical terms is called nexus. It is just like I am wearing a suit or I am wearing pant coat. Nexus is suit, pant coat is connection. Right? So we need not get confused with respect to the fancy terms that have been put either in the law or in the international arena of taxation. So whenever you hear nexus, please consider it as a connection. So if there is a connection or a nexus to a particular jurisdiction, that jurisdiction may get some rights to tax, may get, not shall get, but may get some rights to tax, right? So Indian domestic law, so section 5 says, if you are a non-resident and if you have income accruing arising in India, deemed to accrue arise in India, received in India or deemed to be received in India. These 4 situations, you will be taxed in India, right? And something similar for resident but not ordinary resident. Only one thing additional in this is that income that is accruing arising outside India but from a profession or business controlled from India, even that is taxable for resident but not ordinary resident, right? Resident but not ordinary resident is a very fishy category. Most of the times, they are equivalent to a non-resident, so we will not get so much worried about them, and we'll try and see what we have for residents and non-residents. So I have talked about this. I'm not so sure if everyone can see this at the back. So it's only for entertainment. I'm the main content, don't worry. Even if you cannot see. Right, so section 5 and 6 I have talked about, and based on 5 and 6, we have already classified ourselves that if I am a resident, what income is taxable in India? If I am a non-resident, then what income is taxable in India, right? Any doubts on that? Section numbers have changed, like the subsections and clauses have changed, but section 5 and 6 remain 5 and 6. Scope of income to be taxable income and residential status. 6 is residential status, 5 is scope of taxable income. Any doubts? Because this is a base. Now, since there are no doubts, the whole discussion comes over here as to what incomes are deemed to accrue rise in India, right? Because for non-residents, we said income that is deemed to accrue rise in India is taxable. Income that is accruing rising in India is taxable. Income that is received in India is taxable, and deemed to receive in India is taxable. We will only deduct tax when there is a liability to tax in India for a non-resident. If there is an income of a non-resident which is not taxable in India, do we deduct tax? If there is a payment that is going to a non-resident which is not liable to tax in India, do we deduct tax? No. Why we are not deducting tax? Because there is no liability to tax, right? And whenever we are doing TDS or whenever we are withholding tax, it is in the name of the recipient. It is just a way of collecting tax, but the tax is being levied on the income of the non-resident. right? So we need to be very clear as to when we are talking about income of the non-resident, it has to be either accruing or rising in India or deemed to accrue or rise in India. Received in India is very clear from the bank accounts, right? So the whole discussion always comes to section 9, which says what are the incomes that are being deemed to accrue and arise in India. Deemed means they might not actually be accruing or rising in India, but we are considering, or it's a deeming fiction, we are considering that it will be deemed to accrue rise in India, right? So whenever we are talking about withholding tax or TDS, we are saying section 9, section 9, section 9. So this is the story how section 9 has come into picture, because section 9 is only telling one part. Section 9 is only telling one part, that which income is deemed to accrue rise in India, right? It is section 5 and 6 that is making it taxable. Section 9 is not making it taxable. Section 9 is only defining what incomes or what payments are deemed to accrue or rise in India, right? Once it is deemed to accrue or rise in India, it becomes taxable for the non-resident. Since it becomes taxable for the non-resident, the payer needs to deduct tax or withholds tax. Clear? Loop is clear. So we will see residential status. Based on residential status, what income is taxable. Then go to section 9 to see whether this income is deemed to accrue rise in India or not. If that income is deemed to accrue rise in India, now the payer has the liability to deduct tax under section TDS section. Sir says 195. Anyone says anything else? Anyone says anything else? Everyone agrees 195 for all payments being made to non-residents? No, not all. Which are left, sir? Some specific are left. So if you are paying salary to a non-resident, what is the TDS section? 195. Anyone say something else? 190? 192. So if you go and read the construct of the complete TDS sections that are there in the Income Tax Act 1961, I am not talking about Income Tax Act 2025, 195 very clearly carves out salary, sir. Sorry. It says any payment apart from salary. Right? Salary stays in 192 only, irrespective it is being made to a resident or a non-resident. So when we talk about income that is deemed to accrue rise in India, then there is a liability to deduct tax. Liability to deduct tax on the payer is coming from section 195 of the Income Tax Act 1961, or now section 393(2), subsection 2 of section 393 from the Income Tax Act 2025. Because if you are making a payment today, section 195 is useless and helpless altogether. It is only section 393 subsection 2 that is helpful. So what they have done, they have brought out all the payments that are being made to non-resident, all the sections under a small table under section 393 subsection 2. 393 subsection 2. So 195 replaced by 393 subsection 2. Doubts? No doubt. So new section is 393 subsection 2. Any payment being made after 1st of April 2026 to a non-resident, whether you have TDS liability or not, will be seen as per section 393 subsection 2. Sorry. Right? So I'll quickly tell you what sorts of payments are deemed to accrue rise in India, and then close the loop of section 6, 5 and 9. Right? Then we can directly go to the rates of deduction of tax. When I say what payments are deemed to accrue rise in India, so we'll start as basic as they have a branch in India or some sort of business connection. Connection means nexus. Again, so if a foreign company having branch in India, any income that is being earned by the branch is from a business connection in India, and it will be considered to be deemed to accrue rise in India. Right? If I move forward, what are the major issues that we face? Based on that, those transactions will relate to either interest payments, royalty payments, or fee for technical services payment. Someone asked, payment being made to foreign professional, foreign consultant, right? It becomes part of, or the discussion becomes part whether this payment will be considered as fee for technical services or not. Multiple cases have happened on this, and always there is a different answer, different arguments. So I will tell you both sides of the story But yes, the issue becomes whether this is a fee for technical services under section 917, yes or no. If yes, then it is deemed to accrue rise in India. If no, it is not deemed to accrue rise in India, right? So that is what section 917 talks about, or 97, I think, of the new act. Yes, 97, right? So considering this, interest, royalties, fee for technical service, also dividends, also gifts. If a resident is gifting an amount to a non-resident, so someone has payment made to children, right? So those gifts also become deemed to accrue rise in India. But the point is whether you have income element in that or not, right? Whether you have income element in that or not, that becomes a part over here, right? So these are the major transaction categories that will try and club all the issues in. So someone mentioned payment to children for maintenance, someone asked payment to foreign professionals, someone asked opening up a new entity, right? So all of these payments that we have talked about, one thing there is in common, that they are divided into two categories. Either they are revenue in nature or capital in nature, right? Investment into a foreign entity is a capital kind of a transaction, or is it revenue? Capital, right? I am investing funds into a foreign entity. Is it capital or revenue? Capital. Very clear. Everyone knows, right? So for capital transaction, there will be different treatments, because capital transactions, when the money is going out, might or might not be income. But when a revenue transaction, the money is going out, most of the times it becomes someone's income because it is your expense, right? So from that perspective, we will try and club all the issues that we have discussed today, or I have taken up today, into these 4 or 5 categories, that whether income is deemed to accrue rise in India or not, and if yes, how? And of course, once it is deemed to accrue rise in India, then we need to deduct tax while we are making the payments, right? So I've broken down section 393(2) over here, which is also the older section 195, which says when you need to deduct tax. Because a lot of time the questions come that, sir, I'm making payment which is only reimbursement, what to do now? This is also another issue, that it is pure reimbursement, there is no income element, what to do? Another thing comes that NRI has sold a property, the buyer is saying he'll deduct tax on the complete sale amount. NRI has sold a property, the buyer is saying he'll deduct tax on the complete sale amount and not only on the capital gain part, right? Why these issues are coming up? Because the construct of the section is such, which says any person making payment, right, for any sum that is going abroad or to a non-resident, it needs to deduct tax as per the rate in force, right? So you have to break out as to the triggers. We have any person, so it really doesn't matter who is making the payment. Could be an individual, could be a corporate, could be an HUF, could be AOP, BOI, doesn't matter because it covers any person. Sum chargeable to tax in India, that's what I asked. If the income is not chargeable to tax in India, will you deduct tax? Answer says no. Because to deduct tax, there needs to be a liability to tax in India. India needs to have the taxing right. So if the sum is chargeable to tax in India, only then we deduct tax, right? That is why it never talks about income, it talks about sum. And thus, whenever a payment is being made for sale or purchase of immovable property by a non-resident, the issue always comes that the sum chargeable to tax in India is only the capital gain amount, right? But it doesn't mention income, it says sum. So when sum means gross payment. That is the reason all the payers would say, no, we will deduct on gross. We are not in a capability or a position to determine what is the total capital gain, right? All types of transactions are covered provided they are chargeable to tax in India. So this becomes one of the reasons as to why we are deducting tax. Why we are deducting tax? Because we are sure that there is this sum which is chargeable to tax in India in the hands of non-resident. Thus, the liability to deduct tax comes on the payer who is a resident. Right? Doubts? We are all clear until here? Right? You are all with me? Because as we move deeper into the issues, the base should be very clear. Because if the base is not clear, then the issues become even more technical, which they are not. There are daily life problems. For us, as being consultants, there are daily life problems. This is not something out of the blue, right? We do advise our resident clients as to whether you should have gone in 194J or 194C. Right? Then why do we consider payments going abroad as such a big elephant? It is not a big elephant. Only thing, the section is different. Right? Only thing is the section is different, the construct and little bit logics are different, but the basic principle remains the same. If the income is taxable, you need to deduct tax. Who needs to deduct tax? The payer needs to deduct tax. At what rate? Rate in force. Where do we get rate in force? Rate in force. What does rate in force mean in the sense of section 393(2) or section 195, whatever? Whenever we read rate in force, what is rate in force? Where do we get that? If it would have been in the Income Tax Act, I would have got the reference that please go and see section so and so, right? Where do I get rate in force? Finance? Finance Act. Perfect. So Finance Act gives the rate in force, and thus every year we need to check the latest Finance Act whenever we are talking about rate in force. Right? We have faced issues where a lot of people continue to deduct a tax at the rate of 10% for dividends, whereas it was increased in 2022 to 20%. But since there was a practice of deducting 10% plus surcharge plus cess, they continue at that rate, but the rate was increased in 2022 already to 20%. Right? So we need to check the Finance Act each and every year to see what is the rate in force. Right? We cannot blindly consider the previous year's practice as a precedence to find the rate in force. Sorry. So I've mentioned certain unconventional sections, because when I asked sare rates 195 mein hai ya nahi, so all non-resident payments being deducted in 195, the answer was no. So which are not deducted in 195, I have put here, but now the answer will change. The question is whether all non-resident payments, rates or TDS liabilities are given under section 393(2). Now answer is yes. You need not go in any other section to see payments being made to non-resident, what is the rate of tax to withhold, or whether we need to withhold tax or not. So there were sections on rupee denominated bonds, 194LC, 194LD, 194E for entertainers and sports persons, and all of these sections have been clubbed into section 393 subsection 2. There is a table which has 17 row items, 17 row items under section 393(2), which talks about different types of income and their relevant rate of tax to be deducted. All rates have to be marked up by surcharge and cess. Surcharge and cess. Surcharge, whatever is applicable, 5% based on foreign company. If it's a non-resident individual, then we have 5, 10, 15, which I think goes till 17%, right? And cess, 4%. So all the rates that you see here need to be marked up by surcharge and cess. I'm not going through it. Of course, you'll get the presentation, because these are not, again, daily life issues. We do not see rupee-denominated bonds, interest on rupee-denominated bonds going day in, day out, right? It is reserved for financial institutions and now for some NBFCs, of course, who are getting foreign funding to run the financial institution. So I have mentioned the rates over here. Again, not so important. What is more important over here is serial number 17. The last serial number is the exact replica of section 195. It's the exact replica of section 195, which talks about rate in force. You see over here in row number 2, which talks about any other sum payable to a non-resident. So sum, still, it is any other sum payable. Sum means gross. Sum is never net. Sum is always gross, right? So if there is a sum payable to a non-resident, I again go rate in force. Rate in force will come from Finance Act 2026 now, right? Certain common transactions, the rate has been given now in section 207, which was earlier 115A. 207, which was earlier 115A. It has given rates to deduct tax for interest, dividends, royalties, and interest, dividend, and royalties. It has given the rates already over there. All of them are at 20%, so nothing to worry about. Go under section 207 and see whether if it is interest, dividend, royalties, or FTS, all of them are at 20% tax rate, which was earlier section 115A. 115A became 207, right? So a small decision tree, which I had explained you before, but now is on the screen, that when you need to deduct tax, if the income is not taxable under the Act, there is no liability to deduct tax. Do we all agree? Income is not liable to tax under the Income Tax Act. No liability to deduct tax, thus you will do no TDS and make the remittance. If the income is liable to deduct tax in the Income Tax Act 2025, what we will do? First we will see whether what DTA is there or not. Since we already know the local domestic tax rate, be it 20%, 15, 5, 10, whatever we have seen in the previous two slides. If the DTA is available, if the DTA is beneficial, only then I will take. If the DTA is more harmful, I will not take, right? Because the loss is whatever is beneficial, and the purpose of having a tax treaty was to solve a dispute. If my domestic law only says deduct tax at 5%, why will I go and deduct tax at 15% as per the double tax avoidance agreement? It is only for the benefit of the SSC. So if the DTA is beneficial, deduct tax as per the DTA, of course, based on certain documents. I will show you the list of documents. If it is not beneficial, deduct as per the Income Tax Act 2025 and make the payment. This is a normal decision chart that you need to see for each and every cross-border outbound payment that you make. Outbound, not inbound. I'm not yet on the inbounds. Doubts? Am I going fast? Perfect. Is the decision tree clear? So this decision tree we have built out of practice, and you will not find it in any book, act, or anything. It is only out of practice that we have built how we move forward whenever we are trying to analyze as to what is the rate at which we need to withhold tax for any outbound payment being made from India. I'll move forward. Perfect. So certain issues. Sir, whatever issues will not be covered in this chart, no problem, we'll take it offline. Offline as in what you mentioned earlier, but I'll go issue by issue over here. Payment for software. Sir, again, I'm not talking on the mode of payment. Let me be clear. I'm talking about payment for software. Whether under the Income Tax Act you have a liability to tax in India and thus deduct tax. How you make the payment is your problem. If you are escaping the normal route of making the payment and saying that since there was no check and balance, I couldn't deduct tax, that is your fault. That has nothing to do with the Income Tax Authority, right? So payment for softwares and access to database or subscriptions. We'll take a very basic example. MS Office, everyone uses. Zoom also, now a lot of people are using, right? Very basic example. Let's not complicate as to proprietary databases, market research databases, or for us transfer pricing databases. So we'll not complicate. We'll keep to very simple off-the-shelf softwares. So MS Office, I buy a license, right? 3,000, 5,000, whatever a year, and I pay to Microsoft. There is an invoice that comes, I pay. The question comes whether I have a liability to deduct tax on this or not. But to answer this question in yes or no, I need to again go to the whole cycle of section 6, 5, and 9. I'll see who is issuing me an invoice, whether it's a foreign company, Indian company. If it's an Indian company, nothing doing. As per the cross-border, it's not a cross-border transaction, right? If it's a foreign company issuing the invoice, whether that income is chargeable to tax in India or not, right? So from a software perspective, the Income Tax Act still considers softwares as royalties, so payment for softwares as royalties. So under the Act, you are liable to deduct tax. Under the Act, you are liable to deduct tax. The case of engineering analysis that came in of Supreme Court in 2021 only covers the treaty scenario. As per the Act, you are still liable to deduct tax. So if you are making payment for software, make sure you collect the TRC in Form 10F. If not, you have the liability to deduct tax, right? Yes, it is still debatable. What has happened? They have made a retrospective amendment in the Act covering software specifically in the definition of royalty. Earlier, the issue was whether it is a right to use the software or you have a right to amend the software also, right? If I have a right to amend the software, then definitely it is royalty. Because I am getting a right to the source code, I am amending, customizing and then selling. Or I am making the payment for that right that I have got. But even for off-the-shelf softwares, it has become a bigger issue. But practically speaking, what I am telling you over here, what I have told as of now was theory, but practically speaking, for off-the-shelf softwares, even if you don't deduct tax, it is completely fine. Off-the-shelf means standardized, pre-packaged softwares that you are getting, no problem. So don't worry, sir. To your question earlier that you asked, so don't worry about the previous softwares. It will be litigated, and yes, it will come in the favor of taxpayer only, because it really doesn't make sense. It falls outside the general understanding of royalty, that if there is just a software that I'm purchasing, it really doesn't matter. I get it in a disk, I get it in a pen drive, I get to download, or I get a subscription to that for a yearly basis, right? It really doesn't matter. Earlier, all of these softwares were free. Now for updates we pay, or for keep it running, maintenance, whatever we pay those fees and those money. But for the purchase of software, we need not worry. If it's off-the-shelf software, no need to deduct tax. I'll go on to the next issue. Transfer of immovable property. I'll tell you one important change that has come in this budget as well for this. So transfer of immovable property, our clear scenario is what? A NRI, a non-resident, is selling a property located in India, right? Is selling to whom? Is selling either to another non-resident or to a resident. Have you all seen this scenario? Non-resident selling property located in India to either another non-resident or to a resident in India. The buyer has the liability to deduct tax. Why? Because property is located in India, the capital gain will be chargeable to tax in India, right? From that perspective, there are 2 or 3 options possible, right? First, I deduct tax on the gross payment. So a 2 crore property sold for 2 crores, initial buy price was 50 lakhs, right? Capital gain 1.5 crores. I deduct tax on 2 crore. That is my option 1. That is what majorly happens. Second option is I apply for a lower withholding tax certificate or a lower deduction certificate. Wherein as a buyer, since it is my liability to deduct tax, I apply that I am buying this property from so-and-so seller, right? 2 crores is the buy price. 50 lakh was the cost of acquisition. Capital gain is 1.5 lakhs. I need to deduct 12.5%, considering it is long-term capital gain. I need to deduct 12.5% on 1.5 crores, right? So you give me this certificate which states that if I am making 2 crore payment, how much tax I need to deduct. But if you look at that lower withholding tax certificate, it will be stated that so-and-so payer making payment to so-and-so assessee, who is a non-resident, will deduct tax where the payment is made up to 2 crores at so-and-so rate. So he'll calculate 12.5% on 1.5 crore, whatever the tax amount comes, they'll divide and equate it into terms of the sale price, that is 2 crores. So let us assume, so 1.5 crores, 15 lakhs, approximately 20 lakhs is the tax liability that you need to deduct. So 20 lakhs by 10 crores, it will give you 10% on 2 crores. 20 lakhs by 2 crores, it will give you 10% on 2 crore you need to deduct, right? So what happens that only your cash flow issue is solved, right? If in the first scenario, you would have deducted 12.5% on 2 crores, 12.5% on 2 crores, what the assessee or the seller would need to do? Seller would come, file the return, take the refund. Seller will come, file the return, take the refund. Because ideally speaking, he is liable to tax 12.5% only on 1.5 crores and not on 2 crores. So whatever the differential of 50 lakhs is there, he'll get a refund whenever that person files the return. Only problem is that the cash is blocked, right? So the outcome or the way out over here is to apply for a lower withholding tax certificate. As a buyer, we can apply. As a seller can also apply. There's a specific section for that. Sorry, earlier it was form 13. I'm not so sure the form number now in the new forms. But yes, you can apply for a lower withholding tax certificate. Now, one thing that has changed in the budget was the hardship over the buyer, right? For making payment to a non-resident and deducting tax, you need to have TAN. TAN, not PAN, not permanent account number, but TAN. Because you go and file the TDS returns. Is purchase of immovable property a one-time transaction? Mostly it will be one time, right? Until unless it is our business, right? So considering that in this budget, the government eased out the process, stating that if you are deducting tax on purchase of immovable property from a non-resident, no need to apply TAN. You can do a PAN-based, permanent account-based compliance. From your PAN, only you can deduct tax, file for return. But please mind it, it is only for purchase of immovable property, not for any other transaction. Also, it doesn't cover renting out of immovable property. So if you rent an immovable property and the recipient or the landlord is a non-resident, you still need to apply TAN. Why? Every month you will pay rent, no? So you can file the return. It is a recurring transaction. Purchase of immovable property, one-time transaction. For one time, you don't need to go through the process of applying for TAN. So this change has been brought out in this budget. So wherever your clients are buying immovable property from non-residents, they will not have to go through the hardship of applying TAN, wait, then do the registry, because only after deducting tax, making the payment, you get the registry done with the registrar of properties, right? So that process will save the time over the deal, and you can do a PAN-based compliance for immovable property purchase and deducting tax. Now at what rate to deduct completely depends whether long-term, short-term, and also whether you have a lower withholding tax certificate in place or not, right? Renting of immovable property, as I mentioned earlier, 30% rate in force is there, 30% plus surcharge plus cess, roughly about 31.2. Considering no surcharge right now, only 4% on 30%, roughly 31.2 that comes for renting or leasing out of immovable property from a non-resident. But again, as I mentioned earlier, compliance still needs to be done from TAN. You need to have TAN if you're renting immovable property from a non-resident, and even 1 rupee of rent you pay, you need to deduct tax at 31.2. There is no basic threshold, there is no limit. When you are paying to non-residents, there are no basic exemptions. Okay, if it is 50,000, 10,000, 5 lakh, whatever, we need not deduct tax. That is not the case. Sorry. I will come on to more important aspects of the managerial and training services, and I will also show you one case law as we move forward, recent one. So it will also cover the question that was asked when we are making payments to the foreign consultants or foreign professionals, right? So we need to understand it into two parts. The payment that we are making, is it for a business in India or a profession in India, or is it for a business or profession outside India, right? If it is for a business or profession outside India, then perfectly fine. I may have an escape of not deducting tax on such payment. But if it is for a business or profession in India, I will have to deduct tax. I will take very small example. So when I opened one of my entities abroad, we wanted to get the trademark for our logo of the entity and the name, right? So the question came with the Foreign Trademark Authority was, who is applying for the trademark? My foreign company is applying. Of course, my Indian entity will not apply. My foreign company is applying for the trademark and it will use for its business, right? However, at that moment of time, we didn't have our bank account of the foreign company. It was a new entity, but we wanted the trademark before. So we made payment from India. We made payment from India to whom? Of course, we made payment for the trademark fees, but we also made payment to the consultant who was helping us secure this trademark. Right? So now the first issue or the first debate came whether this is a fee for technical service or not. It is a professional service. And the definition of fee for technical service reads nature of service in the nature of technical, managerial or consultancy. What do you think? Where does this service fall? Whether it is technical, managerial or consultancy, that there was a consultant or there was a professional who was helping me secure a trademark in a foreign country. Where do you think this service falls into these three pillars or these three categories? Managerial, technical or consultancy? Or nowhere? Professional is completely separate. What do you say? Say something. Either of the three or neither of the three? I see roughly about 50-55 people in the room and we all cannot decide, we all are chartered accountants. Then think how the court with a bench of 2 judges can decide this. Right, so this has been a long-term issue. As to always this issue will boil down to the fact whether this fees that is being paid fall within this definition of fee for technical service, yes or no. If yes, it becomes an income deemed to accrue rise in India, and if it is an income deemed to accrue rise in India, we need to deduct tax. If no, then nothing of that sort happens. So there have been multiple judgments, and the recent one has come by ICAI Delhi, which says that these professional services are completely separate. They do not fall as part of any of the three pillars. That they are not technical in nature, they are not managerial and not consultancy. Reason being, these three words have not been defined in the Act. These three words have not been defined in the Act. Neither in the old one nor in the new one. So then since there is no definition, everyone understands it in a common parlance, and the ICAI Delhi recently, last year it said that these professional services are outside the ambit of fee for technical service. In the domestic law itself, forget about the tax treaty. Since it is outside the ambit of fee for technical service, the question of deducting tax does not arise at all. But now the question arises, do I agree with this judgment or not? At some level I do, at some I don't, right? Again, fact specific. As I mentioned in our case, since we were just making the payment for a foreign business to register a trademark to a foreign consultant, I can easily say that this income of the foreign consultant, this income of the foreign consultants has no nexus or connection to India. Has no nexus or connection to India, because if at all I will make any money or he is making this money from this trademark, it is for my foreign business, it is for my foreign company and not for my Indian entity, right? So yes, I might agree to a certain extent that yes, certain professional services might not have any connection to India and thus need not deduct tax in India, but that is not always the case. So I will take you back to a very big controversy that happened. A lot of big businessmen are now in, international court of arbitration. Recently, Jindal Group is also there, Vedanta was also there. There has been some dispute with the parties, and rather than going to the court, they have gone to the international court for arbitration. Right? Now, they are paying lawyers who are situated there to appear in that international court of arbitration. But the case is of the party that is of which is an Indian entity. Now that professional fees does have nexus to India, does have some connection to India, right? If at all, it will yield a good result, good for my Indian company. If it yields a bad result, bad for my Indian company. So that payment that is being made, so the income of the foreign lawyer has a connection to India, right? So even though it's a professional service, may not fall into the part of fee for technical service, but at the end of the day, having connection to India, make it deemed to accrue or rise in India. That is my personal opinion, not the court's opinion. Court says if it is professional, it is outside the ambit of FTS. But yes, there have been contradictory judgments across different ITITs in India, and it will have to be settled as we move forward. Do we deduct tax? Okay, very common question. Do we deduct tax if we are importing products? If we are importing products, do we deduct tax? Anyone says yes? Perfectly fine. Sorry. Offshore supply of services. So what I was taking example of a professional service being performed from outside India, we also see common in very big infrastructure projects. Right? So you see this highway built outside, just outside the property, there is a very big highway. There is a very high chance that the drawing and design of this highway came from a country outside India. That we hired, or the company who got the contract to build the highway, hired architects, hired designers who makes engineering designs or engineering drawings which are situated outside India. There's a very big possibility. Right? So in those scenarios, big infrastructure projects, oil and gas, all infrastructure projects that are this big in size, there almost all times there is an involvement of a foreign entity. That foreign entity is performing services sitting outside India. So let's say for this highway, they gave a blueprint of the design and the engineering drawing as to what sort of material to be used, how will be designed, where it will connect, where will be the exits, how broad the highway can be, how tall the barriers on the side have to be. So complete design came from a company outside India, and the contractor is making the payments. The contractor who got the contract to build the highway is making the payments, be it a government entity, PSU, non-PSU, private player, really doesn't matter. Do you think they need to deduct tax for this service that they have got? Sir is saying yes. Sorry, this is yes, this is no. Not sure. So all my foreign friends, they make fun of our Indian nod. Usually yes is this, no is this. We all Indians will always do like this. So all my foreign friends and clients, when we are in a meeting, they'll make fun. They're like, Rishabh, are you understanding? Yes, sir. Are you sure? Yes, sir. So it's very common. But yes, I assume it was a yes. Right? Anyone says no? It was an offshore supply of service. The people never came to India. They made a design. They just gave a piece of paper to India. Do you think it warrants that the foreign company says this was my income deemed to accrue or rise in India? Again, room full of chartered accountants cannot decide. So couldn't the courts earlier. But now it is very clear, if these are offshore supply of services, these drawings and all are being received, they are not part of fee for technical service, right? So that has been settled to some extent, specifically for this case scenario, not generally for any other offshore supply of service. Now I can quickly take as to what scenarios were left for TDS, if anyone, sir, if you could have the mic. I think I've tried to cover whatever was discussed earlier in the room. If something is left, please raise your hand and speak it out. Sir, can we have the mic, please? So, sir, air conditioner, I cannot listen what you're saying from that side. That is okay, sir. We'll get a mic.
Hello.
Yes, sir.
What about section 6(1)(a)?
Sir.
They use the phrase residence, domicile, or any other similar criteria.
Yes, sir.
Now, does that include a country where there is no tax at all?
Yes, sir.
Because
So I'll tell you, sir, whenever you become a deemed resident based on your nationality and you're not being taxed, that was section 6, capital 1A of the old act, right? Then you automatically become a resident but not ordinary resident as per section 6(6), right? So when you're resident but not ordinary resident, if you have a specific question as to how to relate it to TDS, I'll be happy to answer. But you are a resident but not ordinary resident in that case. Please.
what's the meaning of this phrase? Residence, domicile, or any other similar criteria.
Yes, sir.
Only if you are not taxable because of this reason,
Yes, sir.
the section is attractive.
Yes, sir.
If the country doesn't have a tax at all,
Yes, sir.
is this section attractive? That's my question.
It does, sir. It does.
How?
So basically,
What-
when this section is talking about, or when you look at residential status in any of the income tax legislation, sir, be it in India or abroad, they try and bring that chargeability on 3 factors, sir. Either residence, domicile, or nationality, or citizenship for that matter. So even when you look at any tax treaty also, it also names these 3 aspects, that because of these 3 aspects, you will become a resident of a country. If you become a resident of a country, either you're liable to tax or not, depends on the tax law. Your question being that there is no tax law at all in that particular jurisdiction. Sir, if there is no tax law at all, you need to see whether there is a law which talks about residential status or not, which more likely than not will always be there. Because everyone needs to identify who is a resident of a particular jurisdiction.
My doubt is because of these words, only if you become, due to this particular reason, that because of residence, domicile, or some other similar criteria.
Yes. Yes, sir.
Not otherwise. Not when the country is no tax at all. Like a place like Dubai where there is no tax.
Yes, sir.
It doesn't get attracted, that's my view. Otherwise, what is the necessity for these words?
Sir,
These words become redundant.
ideally, how will you link that person, whether he was liable to tax in other country or not, will be based on either residence, domicile, or citizenship.
No, sir, there's no tax at all. So,
Sir,
what is
there
the
might
question
not
of
be a
residence?
tax law. There might not be a tax law in that country. I do not disagree. Again, this is my personal view. It's an interpretational point that we are talking about. There might not be a tax law in that country. But at the end of the day, there will be some law that will define the nexus of the people staying there.
I mean, do we need to go to that extent? Just plain reading of this section is enough, no?
Sir, if you go and stay, let's say in Bermuda Islands, right, there is no tax law at all. Not a problem. But they still try to define who is a domicile, who is a resident, who is a citizen over there. They still try to define. But ideally speaking, this might not impact you so much or anyone because you become a resident but not ordinary resident from an Indian tax perspective. So only your Indian income is taxable, not your global income. But what you're talking is an interpretational issue, sir. I leave it open to the courts to decide whether it is important or not. But that is my view. Any other point on TDS that has not been covered, sir?
So lastly, you spoke about the offshore services, right?
Yes.
There is little tweaking in that.
Yes.
So the offshore services means like, in my case, what happened is like they had an equipment for which the services were provided. The service provider is in UK, but they took care of all the overhauling, all those things in outside UK or outside India.
Yeah.
And then this service, this equipment or all those things was brought to India.
So your equipment was physically outside India.
Yeah, and services
It
were
was
also
serviced or maintained, whatever, repaired outside India.
outside India.
And then it was brought back.
Yeah.
Yes. Now the question is,
So they have made an they raised an invoice for
Of
the installation and no, they
not installation.
Installation free.
They cannot raise.
installation they have not raised.
Of course.
For the charges of that tool they have raised.
For the maintenance or repair, they can raise.
Not repair. It is a tool which they have bought it from some other place, and that tool it was sent to the other country for doing repairs and all
So
those.
that's what. So they will raise the charge for repairs.
Correct.
Not for the tool.
Yeah.
Tool purchased with someone else. So repairs happened outside India, and they have raised an invoice for repairs to an Indian entity.
Correct.
And the question being whether we need to deduct tax or not. Sir, what is your answer first?
I said it is since everything is outside India.
So what is outside India? When you say everything, what is outside India?
Services rendered outside India.
Right, sir.
There is nothing accruing as an income perspective. There is nothing coming in India.
Right, sir.
It is not a fee for technical services because they will not be able to pass on that technical knowledge of how
So
to.
that is a treaty concept. Forget
Yeah,
about that.
correct.
Yeah. First, let's talk on domestic law. Treaty concept you are very rightly pointing out. There is no make available in India UK based on the India UK treaty. Short answer is no TDS.
No details.
If you want just that confirmation, no TDS.
But only because it is everything is rendered outside India, there is nothing income accruing, or is there any other factor?
For this specific case scenario, yes, sir. But not for all offshore services.
Yeah, definitely.
Yes. Any other point on TDS that has not been covered in the cross-border scenario? Anything? Anyone else? No? If not, we'll move forward. Right? We'll understand other concept. Sir, one more. Allow, sir, Mike. 1 second, sir. It's not audible at all.
Yeah. So this Google Drive space that
Yes,
you're
sir.
paying for, will that come under off-the-shelf self?
Yes, sir. Don't worry. Drive space, cloud storage, all covered. No problem. So I've already talked about the lower withholding tax certificate, and of course I'll not take you to through the process, but yes, you can apply for a lower withholding tax certificate, as I mentioned at the time of sale of immovable property, because you need to determine the value of capital gain, or if you're not sure as to what should be the tax treatment, or if your payer is not getting convinced. So as a recipient, you may apply for a lower withholding tax certificate or a lower deduction certificate, so that you get the certainty as a payer that this is the maximum value that you need to deduct. You need not have confusion as to, I need to go 10, 15, 20, 25. You get the rate specified in the lower deduction certificate, right? I've already taken again also this section 207. As I mentioned, there are certain rates over here with respect to dividends, interest, royalties, fee for technical services, now all at 20%. So you need not go and review the section every time, but all of them are over here at 20%, be it fee for technical service, royalties, interests, and dividends as well, right? So I'll come to tax treaties. Did we all understand the concept of tax treaty as source and resident based on the example of the tree that we took earlier, right? So every time there would some activity that is being done by the source country will warrant some fruit, some smaller payment as we talk and bring it in tax, right? The rule of thumb, we use the tax treaty only when it is more beneficial. Another rule of thumb, whatever rates are mentioned. So for example, I showed over here that 20% tax needs to be deducted in case of dividends, royalties, fee for technical service or interest. This 20% has to be topped up with surcharge and cess. Surcharge and cess. But what you see over here, the rates of any tax treaty that would be there, if say for dividend it says 10%, it is flat 10%. It is not 10% plus surcharge plus cess. One caveat that you need to also see is term of the lower deduction certificate that I was mentioning earlier. If you get a lower deduction certificate, please read it in its entirety. It's a set format which says that the rate mentioned in this certificate does not include surcharge and cess. So even for a lower tax deduction certificate that you get, you need to add surcharge and cess over and above the rate that has been mentioned in that particular certificate. Don't think it's a flat rate. Don't think it's a flat rate. So these are certain practical aspects that we need to take care when we are talking about the rate at which the tax needs to be deducted. I planned some cases over here, but of course we have deducted, we have already deciphered them. So rental income, everything is clear, right? NRI receiving rent. Rate of TDS? I cannot hear, but I assume everyone is saying, right, 31.2, 30 plus surcharge plus cess, right? We have to do a TAN-based compliance, not a PAN-based compliance. It's a regular payment, right? So moving on, interest. So a non-resident earning interest from an Indian bank account. A non-resident can have NRO and NRE account. Both of them ideally taxable, but a specific exemption has been given for interest earned from the NRE account, non-resident external. Please be clear, there is no exemption as to the NRO account interest. NRO account interest is taxable as income from other sources, and the bank will deduct tax at the rate of 20% plus surcharge plus cess on that interest. NRE account interest, since it is not taxable, exemption has been given under section 10. I don't know which is the new clause. Yeah, but the exemption has been given, okay. Serial number 1 in schedule 4 now. So that exemption, because of that exemption, no tax is deducted on the interest that you get in the NRE, non-resident external account. Very common issue that we see, right? Moving forward, sale of immovable property, I have also covered here. To deduct tax at a lower rate, you need to apply for a lower tax certificate, lower deduction certificate. Long term, 12.5% flat plus surcharge plus cess, and short term, 30%, right? Enough time. So coming on to the treaty documents that we need. As I mentioned, yes, we can take the benefit that is there in the tax treaty. The benefit could be in either scenario where it says that you do not have to deduct tax at all, so 0%, or it gives you a reduced rate. So for our example, when we say dividends are taxed at 20%, they might say, the treaty might say, no, tax only 10%. Fine. So reduced rate. Third benefit could be available in case of a definition. In case of a definition, right? To show you a difference, as I mentioned, fee for technical services in the Indian income tax law covers technical, managerial and consultancy. If you look at the India-UK or India-US treaty, it does not cover managerial word. It says only technical and consultancy in nature. So whatever we consider managerial in nature is outside the ambit of the fee for technical services definition, right? So from that perspective, we can get a treaty benefit. When we say to take treaty benefit, primarily 3 documents are required. First is a tax residency certificate, which will prove the residence of the recipient, that the recipient is a resident of the foreign jurisdiction for which we are trying to claim the tax benefit or the tax treaty benefit. So if there is a resident of UK, he will be able to claim treaty benefit of India-UK treaty only when the payment is going from India. He cannot claim any benefit that is there in the India-US or India-UAE treaty. So to claim the treaty benefit, you need to be resident of one of the treaty jurisdictions. You are of course not a resident of India. That is why we are talking about cross-border. So if you are a resident of UK, US, wherever, you need to obtain a tax residency certificate. Each country has its own rules, process of issuing this tax residency certificate based on your legal form. If you are an individual, of course you will get it. But if you are an LLC, LLP, company, corporation, based on the legal form, you get that tax residency certificate. Second is Form 10F. I think it's the new Form 41, if I'm not wrong. Yeah, new Form 41. Earlier Form 10F in the Act was not a mandate. It was recommended if the certain things that they require in the tax residency certificate or the TRC are not mentioned, like email, right? So if it is not mentioned, then Form 10F or the new Form 41 was mandated. But now the wording has changed. Form 41 is a mandate for you to obtain treaty benefit. Form 41 is a mandatory document now. There is no if and but, there is no confusion around it. So this has changed in the recent Finance Act, right? So Form 41 has become a mandate to get treaty benefit. Third important document apart from TRC and Form 41 is the No Permanent Establishment Declaration. So this is a small declaration, 1-page declaration on the letterhead of the recipient, which says that I do not have any business connection in India, I do not have any permanent establishment in India as per the India and whatever, so in our example, India-UK tax treaty. Why we are trying to tell this? Because if that person has a business connection or permanent establishment in India, then the taxability changes. The taxability goes on 35% as foreign company. It is no more on the gross. It goes to net, and they will have to take up and file return here, do net filing, and thus will be treated as a resident over here for that particular type of income. Right? So these are certain aspects that are important when you are trying to obtain a treaty relief. 3 primary documents: tax residency certificate, Form 41, now mandated and online. It's not a physical form anymore. It's an online form, right? And third is your no PE declaration. So basic contents are there in Form 41. that is your email ID, mobile number, where you are resident, your address, name of the company. These are basic contents that any tax authority would need in order to verify the residency as well alongside your tax residency certificate, right? There's another provision which says that if you do not give PAN, you need to deduct tax at a higher rate. Everyone knows about that. If the recipient is not having PAN, they need to deduct tax at the higher rate. But of course, a carve-out has been made for non-residents, stating that if you give these details on the right side, then we will not apply that provision. If you give these details that are mentioned, so your name, email ID, tax identification number, address, if you give us these basic details, then we will not apply that provision of a higher TDS rate. So this carve-out has been given, and when you will fill your TDS return for non-residents, older form 27Q, right? When you fill that, once you say PAN number in PAN column, if you put PAN not available, that is also one of the I would say options that are there in case the recipient does not have a PAN, right? Sir, question? Okay. If PAN not available, then these fields automatically open. It says, please put name, address and all of these things. If you don't put, it applies a higher TDS rate. But again, in the provision, the rate is restricted to 20%. Right? So that provision gets squarely covered for non-residents. From a business perspective, the downside of not determining the TDS rate correctly is not just being an assessee in default. It is not just the 1.5% penalty that you have on TDS. It is also on the deduction of the expense. So from an individual perspective, it is completely fine. Right? I do not take deduction, I am not a business. But if it's a business, then 100% expense is disallowed if you have not made deduction of tax for a payment to non-resident. For resident, it is what? How much? 30%? 30%, right? But for non-resident payments, if you have not deducted tax, 100% disallowance is there. So, you become an assessee in default for TDS, you are paying penalties and interest there for TDS, right? And at the end of the day, you are also not getting the deduction unless you have deducted tax paid to the tax authorities. So that is the bigger downside because that impacts your profitability. Everyone is trying to book more expenses when they want to reduce profitability, in turn wants to reduce their tax base and tax liability. Have you seen a businessman which says, oh, I made an expense for my employees, I've given them a party, but it's okay, don't include it in the tax return? No one says that, right? Even if he is going out with family of 4, the restaurant bill he would want to be considered as employee benefit or business promotion. So from that perspective, if a payment is being made to a non-resident, the downside is 100% non-deduction of that payment if you have not withheld tax properly. Apart from these penalties that are there for you being an assessee in default, late filing of the TDS return, late deduction, interest, penalty, everything would come into picture. So that is the importance when you talk about non-residents payments and deciding as to how much tax needs to be deducted. Perfect. So I have last 15 minutes. Those 15 minutes, 5 minutes I will take or 7 minutes I will take as to the professional things that we do as part of this cross-border practice. So how many of you have signed Form 15 CB? Perfect. So I will give you certain pitfalls and checkpoints. I need not tell you as to how to sign Form 15 CB or how to prepare and fill Form 15 CB, in what situation we need to fill Form 15 CB. Of course, there are 37 carve-outs where you need not give Form 15 CB, only Form 15 CA is enough, but the bankers ask, so we fill. No problem at all. But humble request, do not surrender to the bankers in filling any other form. I have seen bankers asking for a specific declaration separately apart from Form 15 CA and 15 CB. Never fill that. Say, I will give you Form 15 CB, that is the only maximum thing I can do. and the assessee will of course give Form 15CA in correspondence with Part C. Do not sign any private declaration that the bank is giving that, okay, I need declaration in this format. No. Can we sign as per code of ethics? I will not answer. But as a precaution, please never sign such things. Yes, there is a form as per income tax that I can sign. Why not? I will sign, provided you give me all the documents. But do not sign any other form. So with respect to certain pitfalls and checkpoints, I will give you a couple of them. First, never decide the rate of tax based on the invoice only. Never decide the rate of tax to be deducted based only on the invoice. If it's a service invoice, ask for a service agreement. If it's a royalty invoice, please ask for royalty. If it is a software invoice, again, please ask as to what type of software. Because a lot of times, installation, trainings, all of it is imbibed or embedded in that single payment. Ask for the breakup. Because if I say I want to implement a new software within my office, right? That software is costing me $10,000, but they are charging additional $2,000 for training my staff. They are giving one-time training, taking $2,000. Total invoice came as $12,000. I smartly told them, sir, put everything as software fee, no? Put everything in the invoice as software fee. Don't charge me for service, because for service, then I'll have to deduct tax. So please honestly ask your clients actual nature, see the agreement, see the base documents. If at all required, see the email communication. Because what are you trying to certify with Form 15CB? You're trying to certify that this payment is okay to go outside India. This was the gross payment. This is the amount of TDS based on so and so provision, and this is the net payment you should make. This is what we are certifying as part of Form 15CB or Form 146 now. So the liability to judge the rate of tax is on us as professionals, us as chartered accountants, right? And for each default, there is a penalty. I have seen a case where the income tax department called on the chartered accountant under section 133(6), asked to produce all Form 15CB supporting documentation that he has signed in the previous year. All. He has signed 1,050, oddly 15 CBs in that 1 year time frame for multiple companies, and they have asked him to produce all supporting documents. Because 15 CB they already have, that they don't need. But they have asked him to produce all supporting documents as per the list. They gave him the list. These are all 15 CB that you have signed. For each 15 CB, prepare, show us the supporting documents based on which you decided that there will be zero tax. He signed more, but the others were with at least with tax, 20%, 10%, 15%, whatsoever. But 1,050 15 CB forms were there with zero tax. Income tax department, clear, straightforward, asked, please produce all supporting documents. He didn't have anything, only the invoices. So first checkpoint, invoice is not the final document. Please go and see the agreement. Please ask the actual nature of service or the payment that is being made. Second checkpoint, do not fall trap to the banks. If the bank says, I need in a different form, no. I am a chartered accountant, I am bound to give only a form that has been prescribed. I will not sign anything that any Tom, Dick, Harry comes and puts on a paper and gives to me. If it actually means the client is going and getting signed from another CA, no problem. No problem. Right? Third, or the next checkpoint that I would tell you is the treaty rates. If you are stating there is a specific column in Form 15CB, whether this income or this sum is chargeable to tax as per the DTAA. If you say yes, and if you are using that reduced rate, please make sure, as I mentioned, you have the TRC, Form 41 or Form 10F now, and the no PE declaration. Without these three documents, do not sign a Form 15CB for using a treaty benefit. Right? So this becomes the next checkpoint as to if you are using the tax rate. The fifth checkpoint is the conversion rate. Because you need to present the gross payment, the value of TDS and the net payment, both in foreign currency and in Indian rupees. A lot of time people come and ask, कौन से रेट पे कन्वर्ट करना है. Law says SBI TT buy rate. SBI TT buy rate if at all on the date of transaction. If at all on the date of the transaction. But the problem with SBI TT buy rate is you get only the rate of today. If you go and Google SBI TT buy rate, you will get only the rate of today. However, if you look for a repository or an archive, there have been certain good individuals who have taken this rate and compiled into a Excel sheet year by year and currency by currency. So look a little harder when you are looking for an exchange rate. Don't just put USD to INR and put the Google rate, because the Google rate is the mid-market rate. It is a rate at which the banks transact with each other. It is not the end rate of the final consumer. Don't go to xe.com and see the final price into it. Look for SBI TT buy rate. If you look a bit harder, you will find the exact SBI TT buy rate for that particular date, every day that this rate is released and has been compiled into a repository. Right? Another checkpoint or question that comes while filing Form 15CB is the purpose code. Right? So the idea over here of purpose code is to tell RBI what is the nature of the transaction, because it is termed as RBI purpose code. Better ask the banker, show him that this is the nature of the payment I am making. Please tell me which purpose code to be put. I have shortlisted this 2, 3. The point is not all bankers or all bank branches have exposure to foreign remittances. They might not give you an answer immediately, right? So please ask the bankers in advance that this is the payment I am doing, what purpose code do you want here? Because if you put a purpose code A and the bank says B, the payment will not go through. And the bad part about Form 15CB is you cannot cancel it. Can you cancel Form 15CB? You can only reject before the client has accepted and filled Form 15CA. You can fill Form 15CB. From the client portal, you can only reject and say, no, I am not accepting this because of whatever reason. But you cannot cancel that form. But now, for the actual remittance with the correct purpose code, you have to fill another form. So better ask the banker first, telling the nature of the transaction, right? So that becomes an important checkpoint as to while filling Form 15CB or Form 146 now. Right. So, yes, question? Please ask. Yes. 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 I'll take that up. Good question. A lot of times, NRO, the funds have been received in the NRO account. So let's say the NRI has sold the property or whatever has come in the NRO account. Now he wants to transfer to NRE account. The basic question or the basic answer to that is you cannot earn income from yourself, right? And let me be very clear as to what you are certifying. So when you are certifying the transaction between NRO and NRE account, the bankers will always trouble you as to what was the source of this income that has come into the NR account. That is not our purview. Very clear. That is not our purview to check. No matter how that person has earned the income, I am certifying the transaction that is going from NRO to NRE account. On that, no tax has to be deducted because you cannot earn money from your own self. You cannot earn income from your own self. It's a self-transfer. Please be fearless in giving a 0% 15CB or Form 146 now from a transfer of NRO to NRE account. And this is the case which I was talking, that the bankers will give you a small piece of paper to ask you to sign a declaration that the funds that have been transferred or received in the NRO account were also from a legitimate source and the tax was deducted. Sorry, that is not my job. When I am certifying a transaction from NRO to NRE account, I really don't care how did the money come in the NRO account. Right? I don't care. If you are signing that letter, then it is your personal liability now. Then no one will come to rescue. Because you yourself are signing that you have checked that how this money was earned in the NRO account. Ideally speaking, no one should check. It is a self-assessment income tax regime that we have in India. It is the assessee's responsibility to check that whether the tax was paid, deducted, yes or no. But from NRO to NRE account, no tax has to be deducted. Please feel free to sign Form 146, but do not sign any other declaration which talks about the source of funds. Right? Anything else? We have another 6 minutes to go. So if not, I will take one interesting case law, one boring case law also, and then we'll conclude. No doubts? Perfectly fine. So this was the ICAI Delhi case law that I was telling about professional services. The major question over here was whether the professional services fall into the category of FTS, fee for technical service, as per section 917, yes or no. ICAI Delhi over here said no. This is a specific category. It is not either technical, managerial or consultancy in nature. So it is not falling as part of fee for technical service, no tax to be deducted. So I have already told the controversial nature and my views on this judgment. So I will move forward. This was an interesting case. Mr. Ravi Prakash himself is a lawyer. He is from Bangalore. He is a father of a dear friend. But unfortunately, he called us very late when he already made a mistake. Right? So I have taken this example, and I always take this example just to tell how even professionals can be duped into making wrong decisions. So he was buying a property from a couple, one of him, so from two people, co-owners. One of the co-owners were a non-resident, but that non-resident had given a general power of attorney to the resident to sell the property and do everything with respect to the property. Since he was making payment to an Indian bank account of that representative SSC of the non-resident, he said, I will not deduct tax. And we still make fun of him for this. Because he himself being a lawyer, he couldn't understand the fact that income and payment are two different things. Right? So coming from that perspective, very clear what happened. Payment was made to the representative SSC, which was a resident. He said, I will not deduct tax. But of course, we all know what happened in the end. So the courts clearly mentioned that you need to deduct tax. Of course, you need to deduct tax as a payment to non-resident only for the portion of the non-resident, because the department was claiming you need to deduct it on the whole amount. Right? That is also not the case. Of course, court found the middle ground and clearly mentioned the amount that is proportionate to the non-resident seller, you need to deduct tax as payment to non-resident only on that amount. What you have done for the resident is completely fine, not a problem. So clear-cut example of how you can fall trap. Even you are educated, everything happens, because for our own cases, we really don't see or we really don't feel that we can go wrong, right? So this way I mentioned it was an interesting case. So very clear, proportionate amount only is taxable as income accruing arising to the non-resident. For resident portion, deal as a resident, completely different, not a problem. This was another case on softwares, where again the court held that these payments might not be fee for technical services and not taxable in India. Software, neither royalty nor fee for technical service. But please, whenever it's about payment of software, I've given you a general stand for off-the-shelf softwares. But if they are not off-the-shelf softwares, try and look for cases which have happened in the similar industry. Because each industry has its own case law for softwares. So for travel and hospitality, we have a case law called Galileo. So it's a software that all your travel agents will be using to do airline ticket booking. It's the only software that is being used by all the travel agents across India. Right? They don't go to Make My Trip to book our tickets. Right? So that is on this case. And with respect to the time, I have kept it under control, and I thank all of you for patient listening. If there are any questions, don't worry, I am here until the lunch. I am here until the lunch, and we can discuss with that. And with that, I end my deliberation. Thank you, everyone.
Thank you so much, Rishabh sir. For almost 2 hours, the hall remained completely invested in the discussion, which is perhaps the finest compliment any speaker can receive. This has truly made a memorable session. And Rishabh sir has graciously agreed to conduct the Q&A session at 1. I'll repeat. The Q&A session for this particular session will be conducted at 1 p.m. The question and answer session will be conducted at 1 p.m. I request CA Ashik M. Sabu, Sikasa Chairman and Session Chair for the next session to kindly escort CA V. Ramnath to the dais. Ladies and gentlemen, an All India rank holder in both CA Intermediate and CA Final examinations, a senior partner of KS Palanisamy & Co. Coimbatore, a highly respected faculty in direct taxes with decades of professional and teaching experience. It is a great privilege to have with us CA V. Ramnath. Ladies and gentlemen, please put your hands together and welcome CA V. Ramnath. Sir, the stage is yours.
This is sufficient. PowerPoint already okay. You are able to see. Chairperson, other office bearers of the Calicut branch of SARCF ICAI, senior members of the profession who continue to guide this profession, fellow members, happy morning to all of you. We had a very nice interactive session in the morning, followed by my session, but I had to start to next journey exactly by 1 o'clock. I have to wind up. Therefore, the organizer said I can close by 1 o'clock. The Q&A of the earlier session can resume after 1 p.m. so that all your doubts will get addressed. So we will see to that our time is fixed properly, attended properly. Topic given for me is under Income Tax Act 2025, how to dissect Chapter 3, Section 10 of the previous law. How that has to be dealt with in the new law is something which we will have to discuss about. Now, if you see the purpose or the background with which the change was brought into the law at the bill stage, the FAQ went on to say this. What does it say? The section 10 with so much of classes, subclasses, etc. had about 140 aspects to be dealt with, and each of them have person income related classifications. So since it is very lengthy, the government would have made an attempt to make into baskets. See, the existing provision, section 10 class 23 had 15 subclasses and 24 provisos. Third proviso has 7 explanations. Within that, second explanation has again 8 provisos. So such a complex way of reading the law made the government to realize that it has to be recast. That's the reason why the department felt it appropriate to divide that entire section 10 into certain baskets, and whatever areas where the provisions are not warranted because of time passed by, those have to be removed, and 6 different schedules were picked up for making into baskets with the tables. So what are the 6 aspects here? Schedule 2 talking about agricultural income, etc. But it is how the bill, at the time of bill being presented, the FAQ said, but not only agricultural income, any income which is in the nature of return on investment is covered in Schedule 2. We made some investment against which we get some return. That is exempt or otherwise is discussed in Schedule 2. Schedule 3 talks about certain exemptions, specific incomes of eligible person, and Schedule 4 talks about non-resident related exemptions. 5 talks about pass-through cases, business trust, investment income, etc. IFSC units related all grouped together in Schedule 6. Schedule 7 talks about the person itself is exempt from taxation, not the income of that person. The entire entity itself is not liable for tax. That's how these 6 baskets are created. And as a result, the bill claims that, the FAQ of the bill claims that out of 30,000 words available in section 10 of the old law, now it is reduced to 13,500 words, where drastically by converting them into tables, good amount of reduction has taken place, but it will take some time for us to navigate within the table how to understand the law. And the provisos, explanations are made into tables and subsections, etc. So to that extent, it is really saving time for us to appreciate how the law has to be followed. Now, chapter 3 has got part A, section 11. Section 11, previous section 10. That has been now taken to schedule 2 to schedule 7. And part B is section 12. There are two elements there. One is political party, another one electoral trust. So these two are covered in section 12, which is schedule 8. Now subsection 1 of section 11 is a charging provision which says that the income, in computing the total income of any person for a tax year, any income enumerated in schedule 2, 3, 4, 5, 6 shall not be included subject to fulfillment of the condition. If the conditions are not satisfied, the income shall be charged to tax. That's with reference to sir. But except schedule 7, if you see schedule up to schedule 6 it is given. Schedule 7 is separately mentioned in subsection 3 and 4. The persons enumerated in schedule 7 shall not be chargeable to tax, subject to the conditions. The conditions referred to in schedule 7 not complied with or satisfied, then the income of that person shall be charged to tax. So schedule 7 is on a different footing. It says the person itself is not liable. But schedule 2, 3, 4, 5, 6, the person will be liable. The select income will not be liable to be taxed or included in the total income, subject to satisfying conditions specified therein. So that's the difference between schedule 7 versus all earlier schedules. Schedule 8 talks about these political parties and electoral trust. Section 12 talks about it. So schedule 8, political party and electoral trust, the income shall not be included subject to satisfying the conditions. If not, it will get incorporated. So now if you see statistically this provision, originally we had in section 10 140 items. That 140 items are grouped into these schedule 2 to 8 into this format. Finance Act 26, after bill being presented and converted into act, another 8 items are added by Finance Act 26. What was already there in schedule in section 10, out of that 5 items were removed from this entire episode and moved to salary section. That is covered in section 19. So 140 already there, they have added 8, so 148. 5 removed to salary chapter, section 19 covers it. So now as of today, 143 items are there. In schedule 2 to schedule 8 we have to discuss. Now first to take schedule 2. Schedule 2 talks about 17 line items. In these 17 line items, I have mentioned in the table, first column, what are the 17 line items talking about, what is the corresponding provision in section 10 of the Income Tax Act 1961 and what does it talk about. They have grouped it, as I said, schedule 2, though it says agricultural income, etc., it is trying to discuss the return on investments other than agricultural income in schedule 2, subject to satisfying the conditions stipulated therein. So now these are the line items. First is agricultural income, the second is insurance policy proceeds, then payment from provident fund, that is statutory provident fund and recognized provident fund, payment from Sukanya Samriti account, NPS withdrawals, Agniveer Corpus Fund for that Agnipath, approved superannuation fund, scholarship for education. Wherever I made red mark, red colored text we will discuss little later, certain issues associated with that. Otherwise, they are by themselves very clear, nothing further to deal with. Wherever I have colored in red, we will discuss sometime later certain issues associated with it. Payment for award or reward either in cash or kind, and interest on certain bonds and deposits of the central government, gold deposit bonds or gold monetization scheme deposits interest, and bonds of local authority. UTI, old UTI 1964 unit scheme, interest related income, transfer thereof. NPS withdrawals, single time lump sum withdrawal or periodic withdrawals, and few other aspects from old law borrowed. They are not having much of utility, but since the legacy need to continue, they have added in 17th row, table serial number 17, few other aspects are borrowed as it is. Now we will take issues for each of the items in this. Some of the issues we will take up. One is agricultural income. Fairly, we will know how things will take its shape in real life scenario, but certain precautions need to be looked in. Earlier, SSCs were used to take advantage of this agricultural income, and the idea was different, to say how much ever risk is taken, if at all identified, it's a trouble. Until then there is no trouble, was the idea of the SSCs those days. So we used to ask, how will we quantify agricultural income? The SSC's mind, risk appetite will decide. Based on the shortage in that year's cash flow, agricultural income will be decided. But today, in the recent days, things are not that very comfortable. An SSC came, said, sir, I made some Google. My land is agricultural in nature. I have got local authorities' proof that is agricultural in nature. I have sold agricultural land, therefore I would like to either take the benefit of 54B or otherwise whatever other provisions available, I would like to take that benefit. I asked him to come to my chamber, opened that big TV, went to Google Earth software, asked him to say the location. I scrolled it. There was one empty land. He said, this is my land. And that some all leaves were already fallen. They are aggregated together for cleaning purpose. All wastages available in that land, all that is aggregated through a bulldozer, etc. He cleaned and make it as like a small hill. He said, this is the land of mine. Just before buyer coming, I want to show it clean. Therefore, I made all these things. I said, if this is the land, you want to say it's an agricultural land. You would like to offer agricultural income. When I am able to see in my office, without going to your land, that it did not have agricultural activity, will that officer not be in a position to see? Today, Google Earth allows 10 years backward time to see how that particular premises was. You can go back 10 years time. If this is the land today, like this, last 10 years, how this land looked like, from our own office we will be able to see. And departmental authorities approach ISRO, pull out this map with past years evidence, make it as part of the assessment orders. So therefore, it is ideal to say SSC to make certain evidences before making a claim towards agricultural income. Merely because it is greenish, that by itself will not be sufficient. There should be adequate documentary proof to say that there existed agricultural activity. Another controversy is this nursery part of it. Agricultural income demands for carrying out two things: basic operation, subsequent operation. Supreme Court said in old judgment that basic operation is something which you perform before the produce comes up from the bottom to the land. What is underneath, when the seeds are there, underneath the land, whatever we perform is a basic operation. After it comes up, whatever we are performing is a secondary or a subsequent operation. Unless both are performed, they are not agricultural income. So if a nursery plant is taken in a pot and that is cultivated further. And from there you start making money. There is no basic operation, it's only a subsequent operation. But if the nursery plant is originally in a particular piece of land and then after some point in time it is pulled out and made into plots or some other places, then it has got a different understanding. So both the judgments, Supreme Court and Madras High Court judgment, went on to say if the original activity was carried out in the land and subsequently it is migrated to plots, cans, plastic bags, etc., still it will have the character of agricultural income. If there is no connection to land, purely outside land it is carried out, then that is not having the character of agricultural income. But earlier section 10 clause 1 explanation 3 went on to say income derived from sale of saplings and seedlings shall be deemed to be agricultural income. That means to certain extent this understanding that primary operations and subsequent operations both should take place to certain extent. For the saplings and seedlings alone, primary operation is not a mandatory requirement. See, for them secondary is, it appears because of the language of the law that even secondary operation alone would be sufficient, not otherwise. And there are interesting propositions where the property has farmhouse, bigger farmhouse, some portion of which is used by the agriculturist assessee, other portion of which is given on rent to the neighboring agriculturist. That rent received, whether that can have the character of agricultural income or it is a rental income. The land is assessed to land revenue, or if the land is situated outside that territory, it's a rural agricultural land, on that this farmhouse is there, the rental income is part of agricultural income. If the urban agricultural land in which we have this farmhouse which derives rental income, if it is assessed to land revenue, no problem. Otherwise only it is treated as a rental income, house property income. Similarly, equipments leased for agricultural purpose, land itself is leased for agricultural purpose. Many occasions we tend to consider it on a gross basis or a wholesome basis. Our part 4 of the Finance Act categorically says how to compute agricultural income. In that part 4, if you see carefully, if you let out an agricultural farmhouse, outhouse, storehouse for agricultural activity related activities, then income shall be computed as if it is income from house property. That means 30% standard deduction will be applicable. So for the purpose of aggregation, you will offer lesser income for slab rate purpose, but physical cash flow will be more. After claiming 30%, balance only you are showing for aggregation purpose, for rate purpose, but your physical agricultural income will be more. If you do activity by yourself as if it's under business, we will have to calculate agricultural income. That means if the equipments are utilized for carrying out agricultural activity, depreciation on those equipments can be claimed for ascertaining agricultural income, but cash income will be more because of charging depreciation. And if these assets are leased out and we get lease rental income, it will be considered as income from other sources. As if it is income from other sources, we will have to compute agricultural income, and that has to be taken for rate purposes. So if we carefully see this, our amount offered for rate purpose will be something, but amount available for cash resources, for investment, etc. will be more if that particular principle is taken for our discussion appropriately. In the same way, if the money is borrowed for the purpose of carrying on agricultural activity, that interest on borrowed money can also be claimed as a deduction for ascertaining the net agricultural income. The second aspect would be insurance policy proceeds. Earlier, the law was not that very clear. 1010D was saying that in insurance policy proceeds exempt. You have insurance, life insurance policy proceeds exempt. Our tax-paying community and the professional community started extending this benefit to an extent which the government was not happy with. So people started playing and planning very extensively on it, as a result of which government started introducing conditions for claiming this exemption. Keyman insurance policy, very nice product, very nicely brought out by the insurance company. But certain people have stretched this too much, as a result of which now keyman insurance policy is not given at all. Keyman insurance is a case where if the business believes that there are certain key people with the help of whom business will go well, in the absence of them it is difficult to do the business well. So their absence will dent the ability of earning income. In such cases, on their life or on their separation from the business, if something they would like to retire or they would like to resign, the business gets affected. So on their life, the company takes insurance, or the employer takes, businessman takes insurance policy. So in case, in that scenario, if he voluntarily resigns or he retires or something goes wrong for his health, there is an absence that contributes to the negative of the business. To compensate that, insurance company will give money. Till such time you identify and groom another person as a key person. Very nice policy. But our tax-paying community and the professional community took good amount of policies in the name of the partners, in the name of the directors of the company, and thereafter 1 or 2 years later they assigned it in the favor of the concerned employee or concerned director or a concerned partner of the particular firm. After that, they wrote to the insurance company, we are not going to anymore contribute to the partners in the particular policy. It is their policy, they will contribute. And that gentleman, let us say 1 crore rupees on policy is taken. 80% of that amount required to be paid, firm has already paid. Last 20% only due. At that time, they will assign in favor of the partner concerned. And at that last 20% alone, partner will pay. And the entire policy amount, together with the bonus, everything the partner will claim as 1010D after assignment. They will say it's a life insurance policy, no longer keyman insurance policy, therefore it will be considered as exempt under 1010D. And government said all these businesses will not help. If it is a keyman insurance policy at the beginning, even at the subsequent occasion it gets converted into non-keyman insurance policy, it will continue to have the character of keyman insurance policy even if it is assigned in favor of the person on whose name it is taken. So no longer 1010D would be available for a keyman insurance policy. And upon receipt of the proceeds, the law got amended in such a fashion that it becomes income chargeable. 224 got amended. And if the employee receives, if the businessman receives, because that person goes away, businessman receives the proceeds, then it will be considered as a business income of the recipient. In case the gentleman retires and the employer says, you have done 30 years of service with us, you are retiring, have this policy with you, enjoy the proceeds. The businessman can show magnanimity and say, I'll give it to you, but the person who receives will have to pay tax as under the salary, because salary it includes proceeds of keyman insurance policy. Something goes wrong to that particular employee in the course of discharging his official responsibilities, some days traveling, health is not okay, he has his last breath. Now, for that absence, insurance company will give money. The employer may say, okay, let it be given to the employee's family. Income Tax Act says it will be assessed as income chargeable to tax in the hands of the legal heirs as income from other sources. So, end of the day, what would happen? It will be only the insurance premium will be allowed as a deduction in the hands of the payer. Otherwise, all 1010D benefits gone. So that is how we have closed this possibility of availing benefit of 1010D. It becomes taxable now. Other policies, life policies. Life policies, one portion insurance component, another portion investment component. We made it as ULIP, unit linked insurance plan. And the returns are based on the investments made. People will give money, the recipient will invest in mutual funds, based on the returns coming they will give. So it is not an insurance product, rather it has become an investment product, a combination of both. That is also government is not happy with, therefore they say, in case it's a ULIP policy issued on or after 2021, then as long as the aggregate premium paid per annum does not exceed 2.5 lakh rupees, the insurance, the proceeds will be exempt. If annual insurance premium paid in one or more policies in aggregate exceeds 2.5 lakh rupees for ULIP policy, then the proceeds thereof no longer exempt as insurance policy. And People started moving from 2021 not to ULIP. Regular policy itself, they will invest more. So, irregular policy for the sake of life, if you take and something goes wrong, you get money, fine. Now it's like an investment product. Therefore, other than ULIP, any other life policy you take, annual premium paid is more than 5 lakh rupees per annum, then that policy no longer will get the benefit of 1010D. So now that amendment came from 2023. So earlier we already had the ceiling of 20%, subsequently became 10% of the annual value. So up to 2012, 20%, thereafter reduced to 10%. Now 21, 23 onwards, ULIP policies 2.5 lakh rupees, non-ULIP policies 5 lakh rupees per annum. Supposing more than one policy we have, already one policy is taken, that has got annual premium payable. 1 or 2 years later we take one more policy. That premium and the earlier premium in aggregate, in 1 year how much? In aggregate in 1 year does not go beyond the ceiling. Both of them will qualify. You take third policy, that also falls within the limit, no problem. Fourth policy you take, that fourth policy results in incremental number breaching the threshold, then that fourth policy proceeds will be hit by this provision, not the entire one. See, this is what the CBDT circular says. How do you quantify the aggregate annual premium payable? More than one policy you take. Let us say first policy for 75,000, another policy for another 75,000 per annum, another one is 60,000, another one is 50,000. So in 1 year, all the 4 policies available. That year, the payment made is 2,60,000 for that ULIP policy, all 4 put together. The one which breaches 260, on that 50,000 policy, policy D, that proceeds will not be eligible for exemption. First 3 will qualify. Subsequent 2 years, that first policy might have expired, but still that fourth policy will not be eligible at all. Subsequently, in a particular year, the number may come down. Irrespective of that, once this fourth policy is identified as not eligible, its maturity proceeds will not qualify for exemption. Similarly, for a life policy, the premium, the aggregated premium for which policy exceeds the threshold of 5 lakh, that will not be eligible for deduction. Now, interestingly, now that one policy you can't bifurcate. I have seen previous to that policy aggregate premium 4 lakh. Here premium is 2 lakh. I will not be able to say out of that I have unexhausted amount of 1 lakh rupees. So this 2 lakh rupees premium, in which 1 lakh I will go with 5 lakh, another 1 lakh only I will take as ineligible. Out of the total maturity profit, 50% I will claim as exempt, 50% as taxable. Not possible. The policy which results in breach, that entire policy proceeds will not qualify for exemption. So up to first 3 policies, whatever proceeds we get will qualify for exemption. The last one will not be eligible for exemption. Only exception is upon the demise of the person, whatever proceeds coming, that policy proceeds will also qualify for exemption in the hands of the concerned recipient legal heirs. Now, ULIP is an investment. So when you get money back, the surplus will be charged to tax under the head capital gains. But non-ULIP policies, it's not an investment, but we get surplus. So when we get maturity proceeds, that proceeds will be chargeable under other sources. For ULIP policies, taxability will be under capital gain. So rule says how to compute the income. First time amount received less premium paid, balance will be taxable as capital gain. Subsequently, one more installment you get, the second installment minus both the premium already paid until the date. Balance will be the surplus you are getting, that surplus will be chargeable to tax. If it is other sources, non-ULIP policies, premium paid shall be reduced from the proceeds, provided that premium is not sought exempt deduction under old 80C. If you don't get any deduction for that premium, then only that premium will be eligible for deduction. If we have already availed the benefit of chapter 6A for that premium paid, that premium will not be allowed to be reduced while computing your income chargeable under other sources. This is what rule says. It is nothing new. It is there already in the law, but very seldom we take time to discuss these matters. Therefore, I thought it is appropriate to discuss these matters. And correspondingly for this, We have provision also in TDS chapter for the person paying money to subject this payment to TDS. Then provident fund interest. Provident fund return principal portion no problem. On an interest portion, so long as employer does not contribute up to 5 lakh rupees per annum, you pay, no issue. Beyond that you make contribution, or where employer contributes 2.5 lakh rupees, you contribute, employer contribute 2.5 lakh, both below 5 lakh rupees, interest no problem. If the number goes beyond that, then necessarily in the year in which more than this ceiling payment is made, from that time in the PF account for one assessee, 2 separate subdivisions have to be maintained. Opening balance of 2021, exempt component, interest thereon. After 21, that more than that ceiling we pay, more than 5 lakh where no employer contribution, more than 2.5 lakh where employer both contribute. That contribution, interest accrued thereon. Separately, 2 accounts have to be maintained within one PF account, and whatever comes with this tax exempt portion on which whatever withdrawal, no problem. Whatever tax component comes, on which whatever withdrawal comes, that interest component as and when withdrawn will become chargeable to tax. Scholarship or meeting cost of education sought to be given exemption under old law section 10 clause 17, also under new law. Very interestingly, for meeting the cost of education, if the scholarship is provided, it will not be liable for tax. So for our articleship students, we are giving stipend. For them, it is for meeting the cost of education. For them, it is not liable for tax. If they have other income, etc., they want to file return, this stipend need not be counted for the purpose of ascertaining their tax liability. In real life scenario, certain students pursuing PG medical after finishing their UG, they will join PG courses in medical colleges, and government will give them 40,000, 60,000, 80,000 as stipend when they are pursuing their PG courses. It is also to meet the cost of education. So for the PG students pursuing higher education, medical students, that amount what is sponsored to them for meeting the cost of education, there is no need for paying tax thereon. It is not required to suffer any tax. Then comes award or reward, either in cash or in kind. Anything given by central or state government will be sought exemption in this provision. We have seen certain people participate in a sports event. For a particular state, they will win something in a game, and the state will get jubilant. State government will give them award. Sometimes central government will give them award. All that is fine. Appreciating them, if the company gives him something, he has participated in Asian Games, got some medal. For that reason, particular state honors him, fine. In the company in that particular state honors that particular candidate, that is not an award given by state or central government. It is by a private company or a public company or public sector enterprise. That will not be eligible for exemption. What is given by state or central government will qualify. Very interestingly, there is a circular that really shakes our normal understanding of law. What does it say? If the person, that sports person is professional sports person, whatever he gets is in exercise of his profession, therefore it is a professional receipts. If otherwise he is employed elsewhere, he is only occasionally participates in the sports and is an amateur sports person, whatever he gets, it is not a professional receipt, therefore it is exempt under the category of award. And who are all amateur sports persons? Tendulkar, Kapil Dev, Abhinav Bindra. These are the people who are amateur sports persons because they are otherwise employed elsewhere, full time. Therefore, whatever awards they get, whatever benefits they get from third party, not necessarily from them, they are also considered as awards and rewards, and therefore they are not liable for tax. And imagine how the circular is sought to be interpreted. Abhinav Bindra got an award, and he had so much of people started giving him benefits, and we have that PV Sindhu, we have so many people, Sania Mirza, etc. They are called as amateur sports persons. Therefore, going by this circular, they are not liable for tax because they are otherwise employed elsewhere. Very, very difficult for us to comprehend. People who are doing fully the same work but call themselves to be amateur poor person, therefore they are not liable for tax on the money what they receive on account of this. Then comes Schedule 3, 39 items and 4 added by Finance Act 26 and 5 already included here move to salary chapter. Section 19 deals with them. So now, first I have not ordered in the sequential number, I have regrouped based on the nature of the assessee. One is any person fairly, in which 10(2)(a) earlier law presently is serial number 2 in the table. Partners share in the total income of the firm. We may need to discuss certain points therein. Then subsidy received from tea board, coffee board, rubber board, cardamom board, any other similar board by any assessee who is cultivating these items and getting subsidy. Then for an individual these are considered. Travel concession or travel assistance one side. Condition is given in old 2B, rule 2B, now rule 278. But this leave travel concession considered under 10 class 5 of the old law, if an assessee opts for concessional regime, default regime today, that assessee is not entitled for this exemption under 10 class 5 of the old law. That is not eligible. Then other one is allowance or perquisite paid outside India by an Indian government to a citizen of India. So for a citizen of India, government of India pays allowance for deputing them outside India. Foreign embassy, etc. They are sent outside, allowances are paid, government of India pays to citizen of India, that is exempt. The allowance is not chargeable. Then non-monetary perquisite where a tax paid by employer, that grossing up principle will apply. Then house rent allowance, rental related, 1013-year-old law. There again, for a person who is taking the benefit of default regime, this will not qualify for benefit. Then special allowances, old 10 class 14 subclass 1, some 7-8 items were there. So in the course of carrying on employment, an allowance is given, they are posted outside, they carry on their work there, stay expenses, travel expenses, food expenses, all that will come there, transfer from one place to another place, shifting, all that will come under 10 class 14 subclass 1. And 10 class 14 subclass 2 will say quantum. The difference between 10 class 14 subclass 1, 10 14 subclass 2 is this. 10 14 1, there is no ceiling. Purpose is given. Whatever is the amount the assessee actually spends, the recipient salaried person actually spends from the amount received from the employer, the amount will qualify. Let us say for example a person is asked to go to China for doing some work on behalf of his employer. He goes to China, per day allowance given 40,000. Out of that he spends 39,000 rupees per day. Per day he saves only 1,000 rupees. 15 days he was there. Out of the entire amount 40,000 into 15 days, 1,000 he saved out of it. 15,000 will be liable for tax. The entire balance he has spent that day there for his personal expense, his stay, his food, his travel, all will qualify under 1014(1). Actually spent will qualify. If he saves, liable for tax. If it is already spent, quantum is not the criteria. Entire amount will qualify for deduction. In 1014(2), it is on the contrast. Ceiling is prescribed. We had transport allowance. People employed in the transportation companies, they have transport allowance, children education allowance, hostel allowance, and all this specified, car, etc. All these allowances, ceiling is given in the rule itself. Assessee's employer gives some amount. Out of that, the ceiling component, whether or not spent, will qualify for exemption. Over and above will be liable for tax. So 1014(1), quantum is not a criteria, actual spending is necessity. Saving will be charged to tax. In 1014(2), quantum, whatever is given, what is prescribed will be exempt, over and above taxable, but that what is prescribed not required to be shown as actually spent. Whether or not spent, it will qualify for deduction. Now the same 1014(1), 1014(2) reproduced in Rule 280. But earlier, when the old regime, new regime concept came, first time, old regime, normal slab rate. And we had 115 BAC. That went on to say, if you come out with certain deductions and exemptions, we will give you a concessional rate. At that time, when that legislature 115 BAC came in, old regime was generally acceptable. People who would like to avail the new regime should apply for the fact that they are going to new regime. Either in case you have a business, before the due date of filing return, if your return doesn't have a business income, before filing return of income, you will have to avail the benefit by filing the form. Originally for both of them, forms were prescribed. For business cases, form retained. For non-business cases, ITR itself will have one tick component. No need to have a separate form. So there the legislature said, those who are availing the default, those who are availing the concessional regime are not entitled for 10 class 5, 1013A, 1014 subclass 2, certain number of allowances and certain perquisites, interest on housing loan borrowed, and few accelerated depreciation, chapter rate of relating to set off carried forward in which accelerated depreciation, all that is not given to them for persons who are opting for concessional rate of tax regime. And sometime later it is toppled down. Default regime is this. Those who are willing to take the old regime, they should apply for it. The law underwent a change. Now subsection 1A and subsection 6 was introduced in 115 BAC to say, default regime is this. You don't apply anything, you will be governed by new provision. And you would like to get the benefit of old provision with all these concessions, apply. In case you have a business income before the due date of filing return by in the specified form. And in case you don't have business income, along with return you exercise the option. So now, see the scheme of law, 115 BAC, subsection 1 and subsection 5, old. Subsection 1A, subsection 6, default. In case you would like to go to the old one, you have to apply for it. Now the old rule categorically said, that section along with the rule said, in case you are taking the concessional rate, the benefits will not be available. But when they borrowed this into Income Tax Act 2025, this has become default. And you will have to apply for going to old regime. But in the old law, both were there. Earlier period, normal is default, concession you have to apply. Sometime later, concession is default, you have to apply for old regime. Both were in the same section. For that, the rule said those who are going to concessional, not eligible for certain exemptions. But in the new law, people who are going will be for old regime only. Default is this. When drafting, people who are taking the old regime alone will get lesser concession. That is how, unfortunately, Rule 280 has been framed. That means people who are in a default scheme will get all concession under this Rule 280. People who are going for a old rate will get only 5 items. If you see, if people are availing this, they will get 280A, 1A to D and serial number 10. Handicapped people have got the transport allowance. Those who are in a old regime will get all concessions. A drafting lacuna. At the rule stage, only when before the year end they will alter this to see that people who are availing the concession should not get all these allowances and people who are going for old regime should not be denied all this benefit. The intention seems to be different, but the way they drafted, it takes a different shape. And this gratuity paid. Now, in the course of employment, the person superannuates or he retires. In that scenario, that gratuity paid to him subject to where Gratuity Act applies, where Gratuity Act does not apply, all the provisions were there under 1010. Now that law in 1010, not only upon superannuation or upon termination or upon resignation, if something goes wrong in the course of employment for that person, the gratuity amount payable to the legal heirs also covered under 1010 old law up to 31st March 26. But now what the new law says, in the schedule table serial number 38, the family members are covered. An assessee employee himself receives it, not covered there. That is taken to salary chapter. So gratuity to employee is covered in salary chapter section 19. Upon the demise of the employee, if the gratuity is paid to widow, children, dependent, that is covered in serial number 38. So gratuity payment paid to the employee himself covered under section 19. Gratuity paid after the demise of the employee concerned to the family member considered in serial number 38. That one clause 1010 now bifurcated. What is coming to employee is covered, employee's family member covered in exemption. For employee it is included in salary section subject to deductions permissible. And other 4 cases, commutation of pension, leave encashment, retrenchment compensation, VRS compensation, all are moved from section 10 series to section 19 salary section itself. Then these are few more provisions. The daily allowance given to MLA MP or a committee member, allowance to the member of parliament, constituency allowances to a legislative member or a member of parliament, they are all unconditionally exempt provided they are under old regime. If the MLA MP takes the benefit of concessional rate, these are not exempt. They should offer this to tax. In MLA MP explaining them to all these things has got its own challenges, but though section 17 originally allowed, under the section 202, provided you are under the old regime you are entitled, if it is a new regime you are not entitled. Then this compensation paid for disaster by the government or NPS withdrawals, all will be claimed exempt. Some received from a member of HUF, again we will discuss about that little later. That is under 10 class 2 old law, now item number 1 in the table. These are all individual related, other payments, interest payable by government, gallantry award winner pension, family pension of armed forces, minor income clubbed, and scheduled tribe receiving income of Sikkimis, etc., reverse mortgage, annual value of 1 palace of a ruler, all old law getting carried forward as it is. These 4 items are introduced after the Act came into statute, but before coming into actual date of operation. Act came into statute book, but effective from 1st April 26. Finance Act 26 introduced these 4 changes. Disability pension, interest on compensation awarded by motor vehicle accident claim tribunal claims, then income from compulsory acquisition covered under that RCT-LRR Act, then Andhra Pradesh land pooling scheme related exemption, and agricultural land on compulsory acquisition. This has come. We will discuss this. And these are all income of a specified authority. All of these, those respective authorities will claim exemption subject to satisfying conditions. All these entities will qualify for exemption of the specific income subject to satisfying the conditions therein. Now we will take certain issues associated with these particular aspects. One is income of HUF. Of course, in Kerala, the HUF may not have much of relevances, therefore this particular provision will become redundant. But when a assessee files return outside Kerala, but having connections with this professional and seeking services, but his residential address, PAN, etc., remains outside Kerala, and his PAN database itself is remaining outside, he has travelled out, etc., then this may have some relevance. So now distribution of income from HUF to member will not, it should be out of the income. As long as it is out of income, no problem. It is out of other than income, in 56(2)(10) may trigger. Contribution to HUF by member, no problem. Other than member, subject to ceiling limit of 50, liable for 56(2). Any corpus given, clubbing provisions will trigger. That's one important aspect. May we have lesser utility to say. Then we have, next is share income of the partnership firm considered in the hands of the partner concerned. Now, the share income, certain practical aspect we will have to see. The language employed in the statute is that for the total income whatever we get, on the total income, share of the partner will be not liable for inclusion in the total income of the partner concerned, is what the law says. Peculiarly, senior members would acknowledge, we had Chapter 6A benefits in the past, 80 HHC, 80 HHD, 80 HHE, today 80 JJAA, earlier 80 IA, IB, IAB, etc. An SSC partnership firm has got exempt in deduction because of export. Certain benefits under Chapter 6A. Now, your gross total income of a partnership firm, let us say 50 lakh. By availing Chapter 6A benefit, 45 lakhs qualifies for deduction. Now, total income of the firm is 5 lakh. There are only two partners, equal share. Each 2.5 lakh rupees share of the partner in total income. Right? Now, 50 lakh is the income before claiming Chapter 6A. In that 50 lakh rupees, assuming there is no much disallowances, for theoretical sake, 25 lakh rupees will be credited in the capital account of the partner, in the books of the firm. Peculiarly, one officer said, what is credited in the books of the partnership firm on your account is 25 lakh rupees. Net income of the firm, net profit as per profit and loss account, post-tax provisions, on which your share is 25 lakh rupees. But in the total income computation, firm's income is only 5 lakh, your share thereof only 2.5 lakh. 25 lakh you have credited to P&L account, to your capital account, on which 2.5 lakh is only share in the total income. That much only I will allow as exemption under 10(2)(a). Balance 22.5 lakh you have to pay tax. Highly superfluous thinking, extraordinary thinking. Matter gone to board for the purpose of seeking clarification. And board said, fine, if the assess, if what it ultimately goes to say, firm seeks the benefit of Chapter 6A, that gets indirectly taxed in the hands of the partner. Firm seeks the benefit of 45 lakh rupees deduction in Chapter 6A, that 45 lakh is sought to be indirectly taxed as 22.5 lakh in each two partners. That means whatever benefit given in Chapter 6A is indirectly withdrawn. Is this the purpose of providing Chapter 6A? No. So this was apprised to the board, and board has issued a circular to say, if the total income provided in the statement of total income of the partnership firm and the share income therein versus the share income credited to the partner account, if there is a variation on account of any benefit availed in the Income Tax Act, that should not result in taxation for the partners. A simple aspect, but to say this is valid, we had to have a board circular. Now take a scenario. As per the partnership firm deed, whatever is his share in the total income will qualify for benefit. I will take a practical case. There were only two partners, father and son. Father had 75% profit in the partnership. Son had 25% share in that partnership. First year firm had reported 1 crore profit. So in the capital account of the partnership firm, 75% added to the partner A, father, 25 to partner B, son. Similarly, in the hands of the partners in the table, of exempt income in the return, ITR 10-2A, 75 lakhs shown for father, 25 lakh to son. Next year beginning, father said to the auditor, I am aged, my son's file has to have good wealth. From this year you amend the deed. For me 25%, for my son 75%. Partnership deed got amended. Next year profit 2 crore. Partnership firm's book, 25% of 2 crore, 50 lakh added to father's account, 150 lakh taken to son's capital account. Son, while filing his return, claimed under 10-2A 150 lakhs. Inadvertently, in the balance sheet prepared for the father, only 50 lakh is taken as the share income from the partnership firm. But inadvertently, while seeing the partner's capital in the books of the firm as well as in the partners, inadvertently in that auditor's office, one assistant, in 10-2A table for father, instead of taking 25%, 75% yes, 25% number he has typed. Exempt income table under 10-2A, share income from the firm, 150 lakhs he has typed. Son also reported 150 lakh, father also reported 150 lakh, but total is only 2 crore. Father's case is picked up for scrutiny because of huge exempt income. Reason for scrutiny, huge exempt income. Assessing officer asked for details. Auditor filed all the details saying there is a typographical error, it should be only 50 lakh, not 150 lakh. See the son's return, see the partnership's return, anyway it's exempt income. If it is 50 lakh or 150 lakh, what difference it makes? Anyway it's exempt income, it's a typographical error. See the way the assessment is done in the faceless regime. The officer says, you have claimed exempt income 1.5 crore. On perusal of the records of the partnership, 50 lakh is what the firm has given you as exempt income. Balance 1 crore, you claim you have got income which you have invested in partnership for which source is not properly explained. Under 16(9) unexplained investment, this 1 crore 115 BBE I will tax you. Right? Because they say share of the partner in the firm, in the total income of the firm. What is the share of this partner in the total income? That much only you can claim exemption under 10-2A. Firm's income is 2 crore. Your share therein is only 50 lakh. 10-2A provides 50 lakh exemption. You have mentioned 1.5 crore. 50 lakh is permissible under 10-2A. Balance, you yourself has got something else. I am going to add. It's a typographical error. Now that results in an appeal. For this 1 crore, you will definitely agree that 115 BBE will result in at least 1.1 crore tax due, including to 34B. For which 20% if they have to pay 22 lakh rupees, they have to pay while filing appeal, and balance they have to seek stay unconditionally. So this profit sharing ratio of that partner in the total income of the firm, that much only should be claimed as exempt. Very numerical matter, not very great to discuss about it, but a small error in comparison creates sleepless nights to the council. The assessee will not know anything about all these things. If you ask the assessee to pay 22 lakh rupees, he'll say to the auditor, it's your problem, you made a mistake in filing the return, why should I pay? Go and get 100% unconditional stay by talking to JAO. All that the assessee will say so. So now it creates sleepless nights for the council because of a small error which took place in the filing of the return of income of the partners. Therefore, as per the profit sharing ratio of the partner concerned in the total income of the firm, only we should consider, nothing more. Then variation, board circular helps you. The language used is assessed as such. Assessed as such, senior members would agree that in 1992 the taxation of partnership firm underwent a change, whereby at that point in time the government said, firm you assess as such as per the conditions of 184, satisfy 5 conditions as per 184, firm will be assessed as such, interest and remuneration to partner will be allowed as deduction. If I don't file all these 5 conditions, I violate any of these conditions, 185 said you will be assessed as AOP. That's how they stopped. In one of our cases, those days 5 conditions, there must be an instrument of partnership. In that instrument, a true copy of that instrument of partnership duly signed by all partners other than minors should be appended along with the return in the first year. And in that instrument of partnership, sharing ratio of all the partners should be specifically stated. And in every year, wherever there is a change in constitution or PSR, revised instrument of partnership duly signed by all partners other than minors should be appended with the return of income. Lastly, firm should not end up with 144 assessment. These are the 5 conditions. In one of the cases, the firm had initial year very less income. Those days, basic limit was only 2 lakh rupees. Income was very less. The assessee, since income was very less, some 40,000 rupees, he did not claim interest and remuneration, filed a return, manual days, filed a return, but did not append the true copy of the partnership deed in that first year. The assessing officer saw that there is no filing of true copy of the instrument of partnership. He called the council and said, I am going to make it as 185 AOP because you have not attached the instrument of partnership. Fine. The council said, give me 1 day, sir, let me think over. You are saying you are going to convert the firm into AOP, let me think over. Came back, studied. Next day morning he went to the audio officer and said, sir, please proceed. Now, officer thought something different. The assessee's counsel says, please proceed, that means something wrong. We must not do that. The officer said, I will take 1 day adjournment now, I will tomorrow discuss with you. He went back. He studied 184, 185, everything. What 185 says? It will be assessed as AOP. AOP means slab rate. First slab, there is no income chargeable to tax. Now, here for 30,000 rupees, he paid those days 40% tax. 40% of 30,000, 12,000, some TDS was there, he made it up. Now, he converts that into AOP, income will be chargeable to tax at 0. The TDS has to be refunded. So, you follow the law, you have to pay 40%. You do not follow the law, it will be converted into AOP, therefore you will get slab rate. The next day officer said, come on, good deal for both of you. Get a true copy of the partnership deed, I will keep it behind the return, I will treat it as partnership only, not as AOP. It took 9 years for Government of India to realize that if you follow the law, I will tax you at 40%. You do not follow the law, I will give you basic exemption, first slab, second slab, third slab, fourth slab. Therefore, after 9 years, government amended section 185 to say, you do not follow 184, I will not treat you as AOP. I will treat you only as partnership. But however, I will not give you deduction towards interest and remuneration to partner. So, it will continue to be assessed as partnership, but interest and remuneration shall not be allowed as deduction. So, therefore, this assessed as such, assessed as AOP lost its significance. Partnership is always partnership. But since the language is borrowed under new law, even in the new law it says assessed as such. Everything is assessed as such. There is nothing as assessed as AOP any longer. But one important thing in practical life, the last element of this default under 184 of the old law is that firm must not end up with 144 assessment. Very important aspect. In a reassessment proceeding, 148 notice comes asking the firm to file return. Firm takes certain papers to compile. Some time, they give 15 days time. But firm is not able to compile and file return. Time is out. Maximum 3 months they give. Within that 3 months, the firm could not file the return. But number is identified. Yes, a statement of revised total income is identified. Whatever tax thereon the assessee voluntarily pays, gives to the AO. This is my income, this is the tax. Consider and frame the assessment accepting this. Now, officer also agrees in 148, okay, some claim you claim, some claim you explain, therefore I don't continue further. This is the income, this is the tax already paid, I will frame the assessment. Everything is over. Accepted, no dispute. But assessing officer has to frame the order of assessment only under 144 because in response to 148, no return was filed. When he frames the assessment order under 144, if that firm in the original return claimed some interest and remuneration to partner. While framing 144, automatically that interest and remuneration has to be withdrawn. Correspondingly, it will be withdrawn from taxation in the hands of the partner also. But that has its own impact. Firm would have claimed, let us say, in the present day context, 7 lakh or 12 lakh for each partner at interest and remuneration. By claiming 87A, that was not taxed at all in the hands of partner. You remove that from the partner and add it to the partnership. Flat 30% the firm has to suffer. So therefore, this 144 is a very dangerous case for partnership. That means filing of return is mandatory for partnership. Even if the income calculation is incomplete, details are not fully coming up with whatever information available within that stipulated window time, a return has to be filed for reassessment for partnership. Once that is done, subsequently plus or minus can be there, you can explain and then you can give a revised statement of total income and show that payment of taxes before conclusion of assessment to show the bona fide, so that 270A will not be applicable. But at least one has to see that the return is filed. If that return is omitted to be filed within the stipulated window time for a partnership firm and the assessment ultimately ended up with 144, the interest and remuneration claimed in the original return will get withdrawn automatically. That's the danger associated with that case. Gratuity received, I've said we have divided that into two components. Employee coming under section 19, employee's family member upon demise of the employee comes here. An interesting controversy has come. There are certain other cases where employee is no more, employer on a gratuitous methodology gives some money to family members as a goodwill gesture. They are capital receipts in the hands of the employee's family, not taxable. So gratuity amount, if the employee retired on that day, how much payable? That amount as per the contract paid to the family. The family claimed that as a capital receipt, gratuitous payment, but it is covered under gratuity. Now the revenue says for gratuity alone, had employee survived, under section 10 how much he was entitled to? For employee's family also that much is entitled to. If your contract is such that employer pays more, exemption is less, balance is taxable in the hands of employee if he had survived. Employee's family cannot take more than what otherwise employee would be entitled to. This matter reached Bangalore Tribunal. The family member lost the case. For gratuity alone, what otherwise the employee survived and got as exemption, same thing employee's family could get, much more not entitled to. The circular saying employer voluntarily giving certain gratuitous payment on the demise of the employee to the family members would be capital receipt, therefore not taxable. That circular benefit will not be extended to gratuity payment. Gratuity payment except to the extent what is otherwise eligible for employee had he survived, that much only will qualify for it. Over and above will be taxable in the hands of the employee concerned. The bifurcation between section 19 and the clause 38 of table 38 is also endorsing the very same view under the new law. Minor income, clubbed, 1,500 rupees per child basically will be allowed, balance will get clubbed. So long as the relationship of marriage survives, whichever parent has got higher income, if the relationship of marriage doesn't continue, whichever parent is handling that minor, taking care of the minor, in whose income it will get added. That's what the law says. But that 1,500 rupees, 1032 what we are getting, the assessee goes for default scheme. That 1,500 per child also will not be available. Entire minor's income will get clubbed for a default scheme. The assessee opting old scheme, per minor child 1,500 will be available, otherwise not. Then comes the amount of these 5 matters from section 10 move to section 19, salary as a deduction, not as exemption. compulsory acquisition on agricultural land. If it is a rural agricultural land, anyway it is not liable for capital gains, so no problem. If an urban agricultural land is compulsorily acquired, and now one has to explore the possibility of tax exemption. Old 1037A, the present table also endorses, subject to certain conditions. What is that? The land should have been under cultivation for 2 years before the acquisition, either by the assessee or the, if at all, the assessee is an HUF, any family member should have cultivated it for 2 years before acquisition. And also, not only the initial compensation, because of dispute the compensation gets escalated later on. The income increased or enhanced compensation. In the subsequent year when the compensation comes, in that year there is no actual transfer. Acquisition has not taken place. Payment only comes later on. In that year there is no transfer. Still, that for that enhanced compensation also this benefit is available. Not necessarily it is confined to initial compensation. For the enhanced compensation also the benefit of 1037A will continue to be available. Sometimes when enhanced compensation comes, court will say you ought to have paid this money that day itself, because party raised the dispute, today you are agreeing this much, from that day to this day you prevented him from getting this money, therefore pay interest. Original compensation received 10 years back, enhanced compensation I get after 10 years, for this 10 years I get interest also, original compensation exempt under 1037A, enhanced compensation also exempt under 1037A, whether the interest on enhanced compensation, whether that will qualify for 1037A is a controversy. We have for and against rulings, but today the safer course would be any compensation related interest or enhanced compensation related interest. We have section 56(2) read with 57 and 145A class B to say it will be taxable only under other sources, that too only in the year of receipt. You can't spread over for 10 years because it pertains to 10 years. In the year of receipt, assessee has a grievance. If I had spread it over for 10 years, it would have been taxed at different tax rates. That year I might have lesser income, 10%, 20%, 5%. Today you bring every 10-year interest in 1 year, my income goes up, I am exposed to pay more tax, grievance of the assessee. Revenues problem, 10 years they have to redo the calculation, add it, work out tax, etc. So to have a via media between the two, section 57 was introduced to say, okay, for you also no problem, for me also no problem, 50% of that interest will give you deduction. Balance 50% in the year of receipt you pay tax, no dispute thereafter. It's a very good move. So under section 56, entire interest received will be taxed in that year. Under 57, 50% standard deduction available. Year of receipt it will be taxed irrespective of the method you follow, and question of spread over does not arise. A via media has come, having come this particular proposition, still contending that it is part of compensation, therefore I will claim exemption under 1037A is a risky proposition. Recent rulings say we will not allow that. Controversy still continues. Better way, take 50% deduction, offer to tax balance 50%, get rid of this. Anyway TDS would have come, at least balance if you pay, it will be good. That's with reference to agricultural land. The next is where, very interestingly, we have one legislature. That legislature says RFCTALRR, a lengthy legislature. Right to fair compensation and transparency in acquisition of land, Rehabilitation and Resettlement Act. In that act, section 96 says, notwithstanding anything contained in the Income Tax Act, any compensation paid for acquisition of a property under this act, no income tax is payable. That law says, right? Income tax law is silent. So in 2016, board has come up with a circular to say what is mentioned in that law we endorse. Section 96 of that act we also wholeheartedly accept. Any compensation paid under that act for acquisition of a property will not be chargeable to Indian Income Tax Act. There is no provision in the Indian Income Tax Act 1961. Therefore, when we borrowed to Income Tax Act 2025 also nothing was borrowed. Copy paste exercise, nothing was there. Here also nothing was there. Finance Act 26 introduced a specific line item in Schedule 3. While introducing, whatever Circular 2016 mentioned gave effect to compensation on acquisition provided under RCTLRR Act. Whatever compensation, not taxable. But who has to receive? Under that act, it says received by any person. In the table, in references, unfortunately, income tax law says received by an individual or HUF. Having said in the memorandum explaining finance bill that what is given in the circular, we are endorsing it, we are accepting it. Why to restrict only to an individual? When the parent legislature, section 96 of RCTLRR Act otherwise says received by any person exempt, a restriction under income tax law may not survive. That law says if a company has a land in its premises, a portion of the land is acquired under this act and compensation given. Company will say under section 96 of that act, I am not liable. Income tax law cannot restrict further, but needless litigation. One income tax officer will say under income tax law, if a recipient is individual, I allow. You are a company, therefore I will not allow. Test your luck in higher forums. Matter will go to higher forum. It could have been addressed by changing that individual HUF into any person so that it sync with section 96 of that act. Unfortunately, that has not happened. The third change is in the old law. Not explicit law was there, but circulars were there to say people who are participating in the army, including paramilitary forces, in the course of discharging their responsibilities, certain health difficulties would have happened while they are fighting with the enemy or doing some combating activities, etc. Some bodily injury would have taken place. So they have become disabled. In such case, they will have disability pension granted. Now, if the disability is such that they are unable to go to work thereafter, then for the rest of the years they will not be able to work and get money. Salary will not come to them. So therefore, for them, the loss of their service, for which one service component pension, and because of disability their ability to earn has come down. Therefore, disability component pension, both will be given. So their pension will have two components, disability component, service component. If the disability is not too very heavy, they are able to continue their work, go to employment. Till the age of retirement they continue. 60th year they retire. Their service is more, so that their service component will go up. So upon their retirement, their pension will have both disability component, service component, but they will get more service pension because they served for longer period. So now 1961 Act said entire disability pension is exempt. Some novel idea has come to the people in the North Block of New Delhi to say, in case you get a disability pension, that portion of the disability pension, I think they are signaling me about my time, right? So that portion of the disability pension attributable to the disability component will be exempt. Other portion of the disability pension attributable to service component will not be exempt. That's a new line item introduced in the finance bill. The several family members of the people who have worked in military and paramilitary force, ladies, sons, daughters, in social media started writing, our father, my husband, participated in the army, lost one leg or lost one hand, continued in the army further in spite of losing. They served for the army, for this country. The country is having the bloodshed to take that portion of the pension also as a tax. Is this the reward we are getting in spite of losing bodily injury? All that in the social media, several people started writing. So when the bill became act, they retained this as it is, but with a note to say, disability pension, one portion, service pension, other portion, disability. Both will be exempt until such date notified. Instead, they would have withdrawn it. But they have not withdrawn, they retained it. But to say, both the components will continue to be exempt under this clause until a fresh date is notified. The old law now continues. For a person who suffered bodily injury, whatever disability pension, both the components will continue to be exempt unless it is altered in the future date. This another aspect is a person goes on a road, met with an accident. As a result, some bodily injury, he gets claim. He fights for increased claim. The increased claim comes later on. The Motor Vehicle Accident Tribunal passes an award, as a result of which he gets interest. Interest, whether taxable or not. The principal component for that person who got injury, it's a bodily injury that gets compensated. Therefore, it's a capital receipt. Interest on compensation, 56(2), 57, 145A, Class B, all will trigger. Finance Act 2026 comes up with a separate line item in Chapter 3 to say, interest on compensation awarded by Motor Vehicle Accident Claim Tribunal for an individual, not taxable. If something goes wrong in the accident, thereby that claim comes to the family members, legal heirs. That legal heirs also for that interest not chargeable. Now let us take a slight change in the facts. It is the employer who takes the policy on the employee. Employer goes out for employment. Something goes wrong. For that reason, employer gets policy proceeds together with interest. What is given exemption here is only received by an individual for his loss. Even if the employer happens to be an individual proprietor, though it is received by individual, not for his loss, for somebody's loss, for him it is not exempt. If the assessee happens to be a person who suffered a loss, he receives it. To that extent, it is exempt. That interest is no longer taxable. Now let us come back to TDS chapter. Interest other than interest on securities. Section 194A subsection 3 went on to say interest on other than interest on securities, there should be a TDS liability. There, if the interest is awarded on account of Motor Vehicle Accident Claim Tribunal award, earlier the law said up to 31st March 26, if the interest component is less than 50,000, no TDS, above 50,000, 10% TDS. That is now bifurcated. The recipient happens to be individual, irrespective of the limit of interest, no TDS. Other than individual, the recipient gets money, up to first 50,000, no TDS, exceed 50,000, 10% TDS. Corresponding amendment has come in section 393, subsection 4, also item number 70. Then, fine. These are all relating to non-resident. What I need to discuss in non-resident is only NRE account and FCNR account. My earlier speaker has already discussed interest on NRE not liable, interest on NRO liable. There is nothing further, but only point is, if a person has become not ordinarily resident, not non-resident, resident but not ordinarily resident, for his NRE exempt, NRE is taxable, but however, FCNR, foreign currency account, will alone be exempt. To that extent, there is a slight variation. These are all other entities and incomes which are exempt from tax. Pass-through cases, business trust or investment trust. Assessee invest, that trust further invest, gets income. Business income will be taxed there. In the hands of the assessee, it is not taxable. All other income, they are in investment income, house property income, capital gains. The trust will not pay tax. It will pass it on to the shareholder, the unit holder concerned. Unit holder has to pay tax. The trust income and the unit holder exemption discussed here. Then IFSC 12 items exempt. And lastly, these entities are exempt from tax unconditionally. Subject to condition, the entire income of the entities are exempt. Some 49 items are covered. There, only thing what we need to see is a trust. Earlier we had 1023C, class 4, 5, 6, 6A. That is now merged with 11 and 12. So they are no longer found here. But 1023C, we have 3AB, 3AC dealing with substantially funded by government. 3AD, 3AE not funded by government, not approved, but less than 5 crore gross receipt. That line item even today continues. So therefore, what one has to see, these are entities, a trust which has valid registration toll levy, but still running school, less than 5 crore gross receipt, even in new 2025 Act, can it continue to say, I will go under less than 5 crore category, unconditional exemption, 85% condition all are not there, or since because it has toll levy, it has to go by 85% category, old law will continue to prevail. In spite of having toll levy, they can go under less than 5 crore unconditional exemption category. 5 years they can continue to claim so long as there is no 5 crore limit getting breached. Again they can renew under toll levy, nothing wrong in it. Political parties, subject to satisfaction of conditions, these two provisions will allow them exemption. And my concluding thoughts, 7, entire income, all other things, select income. Before claiming exemption, have documentation properly done, because department has got third party data available. Salary income earners all the more careful, because some of the people in the year in which election takes place in that state, they start claiming donation to ATC, GGA, GGB without even actually giving it. That racket got busted. Department started sending notices to those people saying how you came to know about this party, how you have given, etc. Because those parties said, we have got entry accommodation, we have repaid the money. So therefore, salary income cases one has to take care for. This is documentation for professional. 1 minute I would say. These returns we are filing. For tax audit we are taking MRL. For return filing, how many cases we are taking MRL? ITR 2, ITR 3, we file it. That's assessee's responsibility. What is the role in our case? In one of the cases, 44 AD cases, that did not avail 44 AD, he computed P&L, filed it. And he was employed in Bombay, PAN was in Bombay, he migrated to Chennai, but still return was filed electronically in Bombay. Those days, no faceless, face-to-face notice came from Bombay. He asked the council, will you go to Bombay? He said, if you give me a flight ticket, I will go. This gentleman said, I will not give. He himself went. That officer asked, what are those expenses? He said, to reduce the income, my auditor put it. No evidence whatsoever from the debit side of the profit and loss account. He took that statement, in the order sheet he wrote everything, added tax, interest, issued penalty notice. Now the assessee wrote letter to the officer, tax I evaded, I will pay. Interest I enjoyed that money, I will pay. But penalty I will not pay, ask my auditor to pay. Some lawyer gave that idea. The auditor said, why should I pay? It's your return. You only did everything. Matter went to disciplinary proceeding. In the disciplinary proceeding, the council said, it is not a tax audit, it's an ordinary return. Why should I worry about all these things? But the department, the assessee's council came up before the disciplinary committee and said, though it is non-tax audit return, in whose IP address it's uploaded. Now, a retired CBDT member was in the disciplinary committee's heading. That lady said to this council, show me one letter signed by that assessee authorizing you to upload in your IP address. I'll exonerate you. After this problem started, you go and ask for a letter from the assessee finished. While filing return, you will ask for so many signatures. Along with that, one half a page letter, keep it ready. In that half a page letter, write 3-4 sentences. I have given you certain evidences. Orally, I have given certain information about certain deduction for which I have not given any documentary evidence. I have seen the draft written. Whatever I have said, you have mentioned. I am authorizing you to upload this return through your IP address. These 4 lines you get and sign and keep it. Later on, if something goes wrong, this letter will help you. From this year onwards, at least for all the returns filed, whether tax audit return or all other return, please ensure that this half a page letter duly signed by the assessee is kept on record, so that later on, when these exemptions are claimed, deductions are claimed, department comes up heavily upon assessees who have not got evidences for supporting their exemptions. Assessees are getting advised to turn the table and say, it is my auditor who did all these things, I never asked for it. At that time, to save our skin, this particular letter will help us. So keep that in mind. This year onwards, have this half a page letter for all the returns filed in your office. That will help us later on, so that we will not have sleepless nights in future. Of course, I've they have asked me to finish by 12:55. 5 more minutes I've taken. It's 1 o'clock now. Whatever time given, I'm closing it. Thank you one and all for your patient listening. Thanks for the opportunity given.
Thank you so much, Ramanath sir, for that exceptional session. I request CA Ashikim Sabu, Sikasa Chairman, Kozhikode Branch, to honor Ramnath sir with a token of our gratitude and respect. Thank you so much, sir. I request the session chair to escort CA Ramnath off the dais. May I now request CA Rishabh Agarwal to kindly rejoin us on the dais for the question and answer session.
You can sit.
Right, so I've been asked to rejoin for question answers. So if there are any questions, we'll take, otherwise all will go for lunch. I am also hungry. So he's passing on the mic. Please feel free.
Sir, Form 146 issued in place of 13 CB, 15 CB. It asks for ITD REIN of the authorized dealer. Whether this has to be generated by the chartered accountant or by the bank
No, sir,
itself.
bank will do it.
Bank,
It doesn't stop you to complete the form, sir. As far as I have seen, it doesn't stop you to complete the form.
without filling that form,
Yes,
that
sir.
column we can
We have
raise.
filled a couple of them in this year, and banks have accepted.
Okay, thank you.
Yeah. There's another one, it's okay. You can. Okay. Bole, sir.
Sir, an NRI returning in 2020 after his employment.
After?
Employment.
After employment.
But he received the end of service benefits in 2025.
Yes, sir.
And now he is resident.
Yes,
and
sir.
what is the tax liability?
Taxable, sir.
Taxable.
Once resident, global income is taxable. The point is, you may claim that your end of service benefits were received in the year or were accrued in the year in which you were not a tax resident in India. But to do that, you need to make sure you have something from your employer.
Okay.
Some letter, something, because if that was not accrued at all, you cannot say. If that calculation was not made at the time when you were non-resident, you cannot say that it was accrued before. There is a possibility, very thin chance, but if you say that no, it has been received now, accrued now, it's not my previous year income, it is income for this year, then it is taxable. Resident global income will be taxed.
What if it was shown as accrued income in that year?
So if you could say it was shown before, then you have a chance. But you need to have supporting documents for that. When you say shown, what do you mean by shown? As a non-resident in India, you will not show that in the Indian tax return.
Exempted income.
Sorry?
As an exempted income.
Exempt income, if you want to show, perfectly fine. You can show that it is my exempt income, but non-resident. It is income accrued outside India. I show it as exempt. But supporting document, you need to have something from your HR, finance, something from your employer written as to what is this portion of your income. You cannot just simply write and say, it pertains to my employment for so-and-so year. Yes, of course, end of service pertains to your employment. That is well understood. But whether it was accrued in the books of the company as well as your salary for previous year only, right? So that confirmation you would need.
Thank you.
So, my client is going to purchase land from a NRI, and the buyer has provided NRO account.
Yes.
So, just for this one transaction, should I get the TAN for the buyer?
Seller has provided NRO account, right?
Sir?
Seller has provided NRO account.
No,
The
seller
buyer
has
will
provided
give
the
the money.
NRO.
Yes, seller has provided the NRO account, and your question is, do you need 10?
Yes.
Correct? So I've told this before. This year in the budget, the exemption has come that for purchase of immovable property from NRI, you do not need a TAN. You can do a PAN-based compliance, but only for purchase, not for rent. Please be clear.
Okay,
Yeah.
okay.
Anyone else? Sir, please. Sir, mic is coming. Don't worry.
So this provision is applicable from 1st October onwards, I believe. This without TAN.
I'm not sure, sir. If it is from 1st October?
Yes, 1st October
Okay,
only
then
it is
October.
effective. Now we have to obtain a TAN.
As of now, then yes. I might have missed out the part on the effective date. Sir, 1st October. Anyone else? People in the lunch area, any questions? Sir, I will not entertain questions with a plate in my hand. So it is better if you can ask now. So we will take a pause then. If there are no questions, then I assume that the deliberation for today has been very fruitful for everyone, and you could gain more as to what you came in the room with. So if there is anything, you can get in touch with me. I think I'll share the slides with ma'am, and she can take it forward. And just consider, I'll just want to end my session whenever I'm going now in different cities. I always end my session saying that the ICAI has given us already a gift of this degree of chartered accountancy. Never worry as to you need any other professional qualification, education qualification to do any sort of work. Pick up the books of history and you will see that extraordinary people have not come from extraordinary educational efforts, but they have come from doing normal things in an extraordinary manner, right? Pick up any example you want to do, chartered accountant, non-chartered accountant. So, especially for the young chartered accountants, whenever you are looking as to going abroad or as to having a different set of practice rather than doing only practice limited to accounts, audit, taxation, do not think that you need a specific sort of education as to start it, right? Yes, you might need some sort of additional guidance to be an expert on it, but that really doesn't mean that you need or there is an educational barrier for you to start. CA, Indian Chartered Accountancy, is a very well recognized qualification which makes you capable across the board from finance to costing to tax to accounts to audit. That is the purpose of examinations also having an aggregate passing marks and also per exam passing mark, because the expectation is this child should know bare minimum of everything and could be an expert in one of the other aspects. Thus you pull up your marks and get the aggregate done. But because I've faced these questions in especially in tier 2, tier 3 cities, that how do we expand beyond the traditional practice? I think the change begins with the mindset, right? There is no barrier as of now on geographies. And you see that over here, if you see examples of people who've gone outside from Kerala and have made big businesses, I need not take names, but have made big businesses, even chartered accountants for that matter. I think the only common factor that you see is that they have done things differently. They have thought differently, and the change began with the mindset. So with that, I'll conclude that this is the biggest gift that we have got. We have already worked hard to get Indian Chartered Accountancy as a degree, as a qualification. We need not worry as to smaller things, smaller competitions. Think for the bigger picture. Look outside your comfort zone, and you will see that there are a lot of good things that are available. And I've given this message for younger chartered accountants, but of course for the veterans, I know everyone is in different stage of life, everyone has their own way of looking at things, but don't worry, your presence over here itself tells your urge and your commitment to getting on to new things. So I think that's still a start. Thank you all.
Thank you so much, sir. May I request you to join us on the stage, and may I request the chairperson to honor CA Rishabh Agarwal with a memento. Ladies and gentlemen, please put your hands together. CA Rishabh Agarwal. Thank you, sirs. Thank you, ma'am. Ladies and gentlemen, lunch will be served now. May I request all delegates to kindly reassemble in the hall by 2:25 p.m.
I hope you had a good lunch. Not one of the best times to speak, but I hope to give you a good presentation, good insights to where the industry is moving. Because Namkupa, we all know that there's a big elephant that's approaching us, or rather we don't know whether it's a tiger or an elephant. That is AI, right? I'm sure all of you have used ChatGPT. Almost all of you? Okay, so I don't have to explain what AI is, but my purpose of this talk was not planned, or I was totally unprepared, but I just wanted to prepare you people for what is coming and how can we adopt it and thrive in the era of AI. So my intent is not to tell you about a product or a software or this thing, but I'm here more as an industry personnel, industry professional, not as a CA, but as a technologist, 35 years as a technologist in the industry, out of which 25 years I was in Singapore and 5 years in Malaysia. And I have a connection to Calicut. My wife is from Calicut. So I'm happy to launch our product as solution from this event. So my talk is all about now redefining business collaboration, because what AI is going to do, or what is already doing, is it's going to change the way we do business. It's not going to change your business, but change the way we do business, not just internally, but also how do you interact with customers. So my focus today is more on, because customers are the lifeline of your business, right? So the more happy customers you have, the more business and more thriving business that you will have. So the focus for us, or for my speech now, is how can you entice your customers with an AI-enabled services, right? Where you can serve 5x more customers with the current establishment. So without increasing your overhead, how can you increase your revenue? That's my whole theme of my talk. So yesterday I was sitting here and listening to some of the esteemed speakers, especially yesterday afternoon, right? One important message I got, I didn't know this in the CA industry, that if some investigation comes and if the client says that, look, I've given my documentation to my accountant or auditor, and then they will pass that whole responsibility to the CA firm, then the investigators will come and also take away your machines and your data and everything for investigation, right? So that, I was told, can disrupt your entire business until you get back your mission. So how do we avoid that? This is one thing that I wanted to talk here. And data protection and data privacy. So yesterday, Mr. J was here highlighting the importance and the seriousness of data privacy, DPDP Act, where now, if your people are using WhatsApp and other personal devices for communicating, exchange documentation and some data, sensitive data about your customers, you are going to be penalized. And I was told, I can't quote the exact number, but I was told it can wind up a business. The penalty is going to be so severe, that'll be the end of, it'll be a shutting doors for the business. So Data Privacy Act, I'm happy to see as a technologist that India is very much adopting the Data Privacy Act, right? And the delegation of tasks. So yesterday, even the speaker was saying, in fact, what Jay was mentioning about yesterday was, all CA is so busy in their services in getting things done, they don't allocate sufficient time for their marketing, branding, and expansion of business. So how can a technology platform help you to run the business autonomously, meaning automatic mode, and then you spend more time interacting with your customer, maybe getting more business from the world, and that's it, right? So embrace AI. One of the important talk to you is embrace it. You are experts in certain field, let's say in the CA field, accounting, auditing, but AI is for AI experts. Let them do the research on AI, and people like us are here to bridge the gap between AI and your services. So where ultimately, end of the day, you reap the benefits of AI. Yeah. So, not a frightening thing after lunch, after a good ice cream and lunch, but the change is coming. I'm saying again and again, I want to highlight, and it's not a threat, I'm not trying to frighten you, but the change is coming. What happened to our taxi drivers? Does anyone book a taxi to airport now? Meaning our old taxi services, or perhaps maybe in the cities, right? Once upon a time, I do remember when Uber was introduced in India, they could not introduce in Calicut and Kerala, right? But now, what happened? It's everywhere, it's Uber and Ola, right? So the disruption is coming. For example, I have never thought in my wildest dreams I will be ordering a spectacle online. Would you have imagined? Has anyone ordered from Lenskart? This is from Lenskart. I'm not trying to promote them, but that's how the world is changing, right? So my theory is these people disrupted the industry. They did not come and give you a new product, new solution. They changed the way the business was happening. And it completely disrupted the business, right? So they won by redefining how you do businesses. Yeah. Now, I also kept hearing, even yesterday, some of your friends told me, I'm already using ChatGPT. I can upload my document. I can ask my ChatGPT questions X, Y, Z and all that. But remember, that's absolutely dangerous. There's no data privacy. You're going to be liable if that document lands up somewhere. Has anyone connected your email inbox to any AI tool? If you have done so, or if you intend to do so, it's equivalent to sleeping at night, your doors open. How many of you will dare to do your doors open and sleep? It's as good, I would compare to that. So the way that you should adopt AI in our experience and ways, I'm sorry, I think you can't read it at the bottom. So what it says is, the safer path is expert design AI layer. So you have your business layer. On top of it, there will be an AI layer defined and designed by the AI experts in collaboration with CA firms. Adopt your business processes, bring through the AI, and I don't know how many active users of AI here. Please remember, when you connect your the chat model of AI, it takes away everything what you have. You have no control on the data that you are sharing. You don't know what happens with the data, right? And also, it costs money. Today, now there's a news, how many of you read the news 4 days ago that Microsoft has stopped using AI for their employees because now it's becoming more expensive, right? It's becoming expensive than human beings. It's a good news for many of us, but it's just temporary. Trust me, that's only going to be temporary. These things will become cheaper very soon or the other. So my theory to you is, pre-process the data, meaning when you're asking AI something, don't just say, okay, give this whole data of this room and then ask for a question. Precisely say what you want and provide the inputs just what it should be given for your specific question. But I know all of you are not in that line. It's very difficult to do that. That's where we come in. People like us come in, and we will pre-process it in a way that this is what exactly AI engine should get to process the question that you have given. Okay, will AI replace CA firms? Anyone? I'm happy to see nobody. My answer is also no, right? But CA firms embracing AI will replace CA firms who are not embracing AI. That I can write it on a legal valid paper. In the next 5 years, there will not be CA firms who have not updated or embraced AI into their process. Please don't, again, I'm not trying to be very pessimistic here, but what my theory is, our good friends, taxi drivers, like how they went out, or rather they came into Uber, or they came into Ola, right? That's what happened, right? So what I'm trying to advocate here is, be the Netflix of CA firms, your services. And if you ask me, why did I use the name Netflix here, does anyone know how Netflix started? What was their business? Rental DVD. They were like our video shops, right? We used to have, remember in the olden days, we used to have the video shops, cassette rental library. Likewise, actually Netflix was a video, DVD, and this rental company. But when cloud came in the early 2000s, they instantly switched over to a cloud adoption. They thought, why should I give a CD, but then why not I serve it through the internet? People thought they're crazy. Trust me, because way back in 2000, I don't know how many of you had internet connection in 2000, we used to have modems, 56 KB and 128 KBs, right? For even a 1 megabyte file used to take many, many minutes. So people thought they were so crazy, how can you serve a movie over internet? But today, they have not only thrived, one of the most successfully listed company in New York Stock Exchanges, but can you also know that they have disrupted the entertainment industry? They didn't just thrive, they killed another industry. Now, how many of you go to theaters? The movie makers are struggling, right? They're literally requesting us, please come to the theater, please come to the theater. So that's what the technology does to business adoption. So if you can redefine the way you do business using technology, trust me, no one can disturb us. So having said all this, this is a very simple poll. I don't know if you can use your mobile to scan that. These questions will appear in your mobile. So I sincerely urge you to scan it and answer your honest question. And it doesn't ask for name, nothing. It's completely anonymous. It's just as an interesting, I just wanted to get a feel of my audience, what they feel about it. So please feel free to just scan and express your views, what you feel, right? So what do you think of disruption in your industry? I've not thought about it yet. I'm ready, but I don't know how to use it. I'll think about it, but then come on. I just don't believe what Srini, come on, you go your way, I go my way. I just don't care what you do. So that's the fourth one, yeah? So please feel free to have your this thing. So I've told you about all, you have to do this, do that, this thing. But then the next question is, how do we do that, right? Okay, I want to start the journey, I want to do, how do we do that? Look, my current process is already so chaotic. So you know the process is so much of chaotic there, right? People use OneDrive, G Drive. You don't know the security of it. If you have 100 customers, you can't be giving your G Drive access to 100 customers. If you would have just made one mistake of some access control, one customer can read your 99 other customers. So it's very security. I mean, if you don't have an IT team, it'll be very security prone. And multiple people using personal WhatsApp, personal Telegram, that's personal data set. It's not official, it's not formal, this thing. So these are the problems that you typically face. I just want to rush up a bit. How do we solve this problem, right? So this is where our thought process has gone. How do we solve the fundamental problem of communication and collaboration? So the next step, we are redefining the way the businesses collaborate. So our mantra is multiple communication channels should now be through one collaborative channel. So let's convert communications into collaboration, right? So they say, right, there's a difference between hearing and listening, right? So that's the thing that we wanted to bring about the change in this thing. Yeah, the next. So here you would see a typical firm at the center. They are connected to, so now imagine these are all, just for a moment you think of Facebook networking, right? A friend of friend of friend of friend, 5-level depth, 6-level depth. All of us are connected. If all the businesses are connected like this, imagine the data flows privately and securely, and even more, it's easier. The cost of doing data collection becomes far more cheaper, and it becomes organized. The one thing that we give you an example of how we organize is, imagine just that one data pipe that goes between an accounting firm and a client. Every business process will go through one channel now. So you don't have to have multiple tools, multiple platforms, multiple apps. To do that is just one pipe, and this pipe is end-to-end encrypted for every customer, which means an encryption between customer A and you and customer B and you, they are completely different encryption keys. And you control the keys. We don't control the keys. Yeah, so we bring, we help you escape email calls, collaborative document management, professional chat, comprehensive audit trail. Every activity that happens through this collaborative channel is auditable. When I say auditable, in terms of IT audit, that's it. Who did, when, what, and all that is traceable for any regulatory purposes. The productivity improvement and enhanced security and privacy. So just to give you an idea, you can see the chat interface is very familiar to what you guys are already used to, right? Like WhatsApp or any other Teams, Slack. It's the same WhatsApp interface, but then the biggest difference is this is business grade. What you see on the left side is all business names, and within businesses you see transactions happening. So if you have multiple transactions with the same business, that's what you see. And on the right side includes chat, document management, and e-signature is included in that, right? So this is what I said, everything combined into one collaborative channel. So this is document management. What I just wanted to explain, let's say if your client has sent you an invoice using the app, from their app, it'll come and sit inside that same client's name inside the invoice folder. So nobody in your office have to do any document management. The system, the agent behind the scene, it does the document management and pushes there. So that, you don't need people to do that anymore. That people can be used for much more effective auditing work. Likewise, we have the document management. Go ahead. Yeah. Now, this is one interesting task. When some clients ask you a question, you want an employee to take care of it. You can then put a task for it under the employee name, and you can see all your employees, what the tasks are, and at the bottom you see the familiar chat interface. You can use AI. Hey, can you tell me who the most productive person is? How much this person is doing? How many tasks is getting done within a week, within a month? Everything is what you ask. You can ask the agent, tell me about the tasks that I have. What are the most outstanding tasks? Which client has the most outstanding tasks? So now it becomes an AI-powered task management. Okay. I just wanted to show you how AI helps to convert a document into a data which is pushed to Tally or Zoho Books or any other accounting packages automatically. You can play that. Okay. Yeah, so you select the files. You select a bank statement now and say just, you are asking the AI is working on that file now, and you just see it only takes about few seconds. Within that few seconds, the digital data set, yeah, it's already extracted. You see that your physical file is now converted into a data file, and that data file automatically goes to you tell us what accounting package you have, Tally or Zoho Books or QuickBooks or any other book. We will customize that one-time interface. If you find a mistake, you just saw that you can do manual corrections as well. And what the beauty of this is, if you make any manual connection, the system learns that, oh, I put there this 5,000, but the user corrected as 6,000. Next time, it will auto-correct that mistake. So it learns from what it does. That's what I was saying. You can skip that, Renix, yeah. So these are more explanation of what I just explained to you. Okay, yeah. So the business outcome of such collaborative platforms. So what we are here to say is not just preparing you for AI, the outcome of AI era, but also say that, look, these are the business outcomes. We can guarantee that more than 80% of your document processing can be automated. That is for sure, if not 90, right? So 90% faster compliance from handling, meaning for a lot of forms, you need to have structured forms related to each other, and you need signatures on time with audit trail, is all automatically taken care of. What we are saying is a lot of thousands of man hours in the manual process is now going to disappear. So that's how you improve your productivity, right? So zero infrastructure maintenance, because everything is in the cloud taken care of. But for those customers who are not comfortable with cloud, you want it on your machine, it's possible to install it on that machine as well. And the mantra is, next. Okay, so like I said, why now, right? Because CA firms risk from staffs turning around, manual processes, and most importantly, other accounting firms embracing AI, right? That's a reality, right? Traditional business processes are getting disrupted. Now our question is, how can SMEs operate at the same efficiency level as corporates? So we wanted to uplift SMEs to the level of enterprise automation and enterprise IT level at the lowest affordable cost, right? So we bring you that facility. Next one. Okay. So next one. Yeah. So you go to that web page. Now we can see what the poll results are. By the way, that's not my house. Done. Okay, I'm done, but just just one the outcome of the poll that I just wanted to see. By the time they bring it up, I really appreciate for this opportunity and thank you for your patience listening. I hope it was useful. It's not all doomsday. It's all like, we can win it together, just embracing technology. So that's all with that closing notes. Wishing all of you a very best and a good day, rest of the day. Yeah, thank you.
Thank you so much, sir. Ladies and gentlemen, we shall now commence the final technical session of the conference. May I request CA Rasha Abdur Razak, member Kozhikode branch, and the session chair to kindly escort CA Gopal Krishna Raju to the dais. Ladies and gentlemen, a distinguished chartered accountant with over 26 years of professional experience. He is also a cost accountant, company secretary, insolvency professional, and registered valuer. He specializes in taxation, restructuring, due diligence, and valuation services. He has served the profession in various leadership roles, including as treasurer of SIRC of ICAI, and is widely recognized as a speaker and educator. We are delighted to have him with us. Please join me in extending a warm welcome to CA Gopal Krishna Raju. Sir, the floor is yours.
Very good afternoon, friends. At the outset, let me thank Kozhikode branch of SARC of ICAI for this wonderful opportunity to be part of this two-day national conference on direct taxes. Before I venture into the subject, I am reminded of my association with Kozhikode branch. I have visited here as a faculty member, and my association with the branch is more than 15 plus years. And especially now when I look into the committee members, I am reminded of my association with the then students of ICAI. Fortunate to be part of this particular branch, especially the north of Kerala. Those days we used to travel. When I say we, along with me, few other faculties also, we used to travel by train to Calicut and stay here for at least 2 or 3 days. Our weekends used to be spent in Kozhikode, and those days' remembrance are still fresh in my mind. I could even meet some of those days SICASA chairman. Then they have become chairman of the Kozhikode branch. So those memories are still fresh and lingering in my mind. And Calicut always is a second home for me, because some of the very crucial time, especially the pre-exam crash courses, we have spent our time here. Coming to our topic today, we have a very limited time, but I'll try to focus on few important aspects. I am actually reminded of one anecdote. This is one gentleman who was actually bulky, and what he did is he stepped into a weighing machine to check what his weight is. So after he put the coin, he got a ticket, and in the ticket it was that sentence was like this: so kindly do not, 2 people are not permitted to step on the weighing machine. So then he understood that his weight is actually over. So he thought of going to a weight reduction program. So he went to there was a lot of, today nowadays you see a lot of boards. So slimming clinic. So he went there, and that young receptionist there, after getting this new customer, so she said, okay, what do you want? No, I want to reduce weight. What is the package available with you? Sir, we have 2 types of package. One is ordinary package, another is a special package. So he thought, why should I go for a special? I'll try an ordinary package. So this ordinary package said, okay, you go inside this particular room. People there will train you. So he went inside that particular big hall like this. And inside that hall, the chairs were not arranged like this. All in a topsy-turvy, the chairs were there. And as though some fight has gone inside. So in the corner of that hall, there was one young, beautiful lady was standing there, maybe between 18 to 20. And by looking at that young lady, this gentleman got, okay, let me go and touch her. Okay. So as he went very near to her, she started to run. So he also ran behind her so that he can touch her. So he tried his level best to run behind her to touch. He couldn't touch. So exhausted almost by 15 minutes to 20 minutes, he got exhausted. The receptionist opened the door. So the weight reduction program is over for today. So please come back for the next 10 days. You will reduce your weight. Now he came and he sat in the reception. Okay, if the ordinary package itself is like this, let me also try the special package. So he said, no, I want to try the special package, then I want to go home. Are you sure about it? He said, yes. Okay, God save you. So then he said, please go inside this particular hall. That hall also was very big. And again there were chairs. It was actually topsy-turvy, spread. And there at the corner, the end of that particular hall, 85 plus to 90 plus old lady was standing there. And that lady was coming towards him to catch him. So he was running around trying to go away from that particular lady. And after 5 minutes, she opened the door and he said, if at all you run like this for next 4 days itself, the course will be completed. Income Tax Act 2025 is like that, where we were going behind 1961. Now 2025 will be coming behind us. Okay. If at all we don't move forward, we will be If at all we don't move forward, you will now see what will happen. Of course, I will not be a tax teacher here. All of you are well read and experienced in 1961 law. This is 1 year my teacher of income tax taught me that 1961 is a very powerful number because the water image of 1961 is also 1961. The left to right, right to left is also, you read it as a mirror image, it will be 1961 only. So such a very unique number, powerful number. And if at all you should experience a very similar number like 1961, we have to wait for another 4,000 years. Because that year will be 6009. We may not be alive. Now, 2025 law, I have just made some comparison. Here and there I will be making, I will not mock at the law, but how the law has actually come up, that is what I will be presenting to you. If you look at this numbers, okay, the section that is you part A, B, C, D, E. Of course, B is not there. So A, C, D, E, and F. Your head E is your capital gains, and your number of sections is from 67 to 91. I will bring your attention to the charging section, which is 45. 45 actually it will have only 6 subsections in your 61 law. But look at this, you have actually 18 subsections in 2025. Why? Because some of the subsection which has 3 subclasses has been made as 3 subsections. So these kind of, I will use a word called restructuring has been done. But where and all they have made an effort to re-engineer, okay, there is few places where re-engineering has taken place. Majority of the re-engineering are towards, I will say, revenue-oriented, assessee-oriented re-engineering. There are places they would have done, not done. So I will also refer those aspects. Of course, your classes, instead of the I, double I and triple I, they have made it as A, B, C, D. So these kind of, I will use cosmetics change or restructuring they have done in the Act. And provisos actually has been merged into a subsection. And most importantly, if you look at that proviso, it used to be a standalone proviso. It is actually an example I have given as 71C. I'll go into those. Maybe it will take time for us. If I say 1961, 50 capital C, immediately you can relate. But the equivalent of 50 capital C, if I give a 2025 number, it will take time for us to get registered in our mind. So 1 year we have to actually take it forward. I will take you to one particular section. Maybe before I go to all this, I want to bring before you 536-2C. Okay, this is the last section. I repeat, last section. But this one section will keep, maybe even though I have bought a book of 2025, the applicability of this law in practice will take 1 more year. Maybe we'll open this book and read in the current year for tax computation or for payment of taxes, advance taxes. Apart from that, we may not refer. Or maybe rules we may refer for which particular form number. But please look at this section. This makes your 1961 law live even today. So 1961 law, actually for many of us here, for everybody here, 1961 law is an emotion for us. Okay. So that means if it has been repealed, actually I can't believe until I read this particular section. But this is a saver. Okay. The provisions of the repealed Income Tax Act 1961 shall continue to apply. Continue to apply in 2 circumstances. Any proceeding pending till 31st March 2026 will continue in same 1961 law. There are certain proceedings which will be initiated now pertaining to the previous year, pertaining to an assessment year. Then, so any proceeding initiated on or after 1st April 2026. So, except for few of these kind of sections, many places, okay, actually, if you sincerely ask me, you have come here as a speaker, have you read the entire Income Tax Act at least once? So I will swear on the Bible and Quran and Gita, I have not read it, but only those chapters. I must thank Institute of Chartered Accountants of India. So whenever they give an opportunity, because another 2 or 3 days later, in Kadapa branch, there is another topic I am discussing. So opportunities like this, maybe for speakers like us, we go deep into it, keep the 61 law, 25 law, read, underline, see the minute differences, understand. I'll bring before you many such aspects here. I am actually reminded of one such dialogue between Einstein and Charlie Chaplin. Charlie Chaplin, there was a film of Charlie Chaplin which was premiered. It is called City Lights. On 2nd of February 1931, that film was premiered, and for that premiere, Charlie Chaplin has invited the great scientist Albert Einstein. So, both of them are meeting for the first time and they are having a dialogue. Okay. And especially Einstein started the dialogue with Chaplin. So, Chaplin, you are such a great comedian, actor, and you don't even speak a single word, but the entire world understands you. So, you are very great. So, So that's what Einstein actually appreciated Charlie Chaplin. Now Charlie has to respond to that statement. Charlie Chaplin responded, no, Einstein, you are actually greater than me because you speak many things and the audience, they don't understand even a single word what you speak. Okay? So you are greater than me. But Income Tax Act 1961 used to be like that. You have to read 3-4 times. Especially certain sections, you read as many times as possible. Read 1 week later, you will get a new jnana, the new dimension to it. So the law actually maybe 1 year later you read, you will get another dimension to it. So, but your 2025 Act is not like that. Yeah, it's very, very nadan, very straightforward. Wordings are not minced. As I proceed, you will understand that it's like in a Padayappa movie, superstar Rajinikanth and the Sendil, both of them, they will go to see a bride. On the way, Sendil's shirt will be soiled. So Rajinikanth will give his shirt to Sendil. Now, people will come because they are going as a crowd. Out of these two, who is the Maapla? Further, Rajinikanth will say, Maapla ivarda, but our potent rekara satte ennidu. The kind of 2025 law, the substance is same like 1961 law, but the way they have actually presented. So that is why I will use a word called restructuring. Majority places it is only restructured. So such proceedings shall be carried out as per the procedures specified in the Repealed Income Tax Act. Now I will take you to one by one. Now please look at this small comparison. 45 to 55A, that is from 67 to 91. That 18 subsections I have made. Now please look at this. This charging section is actually re-architect. I'll come for only one particular very interesting change which they have brought. Just look at this particular aspect alone. Okay. Maybe as we go we will understand. So this is the total dimension which they have actually maybe grouping of the entire provisions. Okay. Like I have given you the right hand side number is actually the 2025 and the left hand side is actually the 1961 law. Maybe this 67 to 91 I have actually grouped into 4. If you look at that rollover exemptions part, you used to have only that one section called 54, 54B, then 54EC and F and all. Now they have numbered it separately. Okay. So it will start from 82, 83, 84, 85, 86. So like that it will go. So you have a separate section. Now the cost of acquisition, valuation officer. So all these provisions remain same. Only the section numbers have changed. I'll bring before you this one example how one subsection has been divided into 3 subsections. Look at 45(1)(a). So this is whenever you get a insurance claim, so then how would you have to consider? It's an actually notwithstanding provision, but please look at the 3 single purpose subsection. If a person receives money or assets, because there can be an exchange, for one car they give another car. Under insurance on account of damage or destruction, look at the English, there and here. Totally different. Profit chargeable as capital gains in the tax year of receipt. The circumstances is same, and this insurer definition used to be an explanation. Now they have made it as a separate subsection. So this is how, so I don't want to take you to the entire law, but this is how the change, I will use a word called restructuring. There is no re-engineering here, it's only restructuring. But wherever they have done a re-engineering, I will refer. This is one place where re-engineering is done. In the name of restructuring, they have done. For example, please look at this 45.1 and 67.1, the charging section, especially, So any profits or gains arising from transfer of a capital asset, they included 54, 54B, D, E, A, E, V, F, G and H. But they have missed out this. Under 61 Act, exemption under 54 EC and 54 GA. That EC is actually long-term capital gains from the land or building into specified bonds. And also 54 GA, capital gains on shifting to the SEZ area. These two doesn't form part of 45.1, but 67.1, you have a corresponding section. Of 54 EC, you have 88, and with respect to 54 GA, you have 85 and 88. So 85 and 88 are those two corresponding sections. So here they have done a re-engineering. So whether it will be pro-revenue or pro-assessee, if you ask me a question, it is neither, but they have done this re-engineering. But there are certain places where they could have done pro-assessee, okay? So they have missed out, okay? So this is another place where I want to give the example where the subclasses III has been replaced as only A and B. Okay, so you can actually look at that English, it will be same. Okay, so word to word is almost same. So look at expenditure incurred wholly in exclusive in connection with such transfer, which is an expenditure eligible, same. So they have not changed anything. So it's not even restructuring, it's only renumbering. Now here, maybe because we are auditors, what comes to our eyes is the mistakes. Maybe it is an unintentional one, but this has happened. Please look at the section 50 here and the equivalent of 74 here. Okay. Actually, what is 50? This is with respect to the return down value of the block of assets at the beginning of the previous year. So, look at 52. The cost of acquisition of the block of assets shall be return down value of the block of assets at the beginning of the previous year. So, there is a cogency connect between 50 subsection 2 and 50 subsection 1. But look at the equivalent here. 74 2B is the equivalent of 51. Return down value of the block of assets at the start of the tax year. Start of the tax year instead of beginning. Look at 74 3A. Cost of acquisition of the block of assets shall be return down value of the block of assets at the beginning of the tax year. So maybe each subsection has been given to one officers. So while collating, this connectivity would have been missed out. Maybe in the years they may amend it. So something like this actually comes to our mind. Okay, so these kind of mistakes only attracts us first. Now maybe your 50C corresponding section is 78. Okay, so very nicely they have worded. Now actually this subsection 78.3, if you go to the section 50C, it will be almost 6, 7, 8 lines will be there. Okay. So instead of that 6, 7 or 8 lines, they made it as 2 lines. So that means if the consideration received, okay, so your actual consideration, if it is less than stamp duty value, stamp duty value will be treated as your deemed consideration. Exception is that the 110%. So all these are carried over. Now 78.3 is the only place where they have done some re-engineering with the words. Okay, with the words. If the value determined by the valuation officer exceeds the stamp duty value, such a stamp duty value shall be taken as a full value of consideration, unless and otherwise it is referred. So only if it is referred, then it will come. Otherwise, 78.3 will not come. So I have given some 3 or 4 scenarios. Actual consideration is 100, stamp duty value is 20. So technically 120 will be 78 deemed consideration. But if it is referred to the valuation officer, and valuation officer comes with 125, 125 will be taken as the deemed consideration. So that means it will be substituted by stamp duty value. So that is what. So if the value determined value exceeds the stamp duty, such stamp duty value shall be taken as the full value of the consideration. So it cannot exceed. So that's what they mean it here. Stamp duty will be your final, even though it is above that. Okay. So quite meaning they have not changed the concept, they have not changed the substance. What they have changed is only the English presentation. Okay. Yeah. Now come to this. I was referring that proviso also becomes part of. Proviso also becomes part of your section. Please look at 47.4. Actually, what is transfer, what is not a transfer. So that is one particular section which is very important, especially what is not a transfer. 47. The exemption for parent to subsidiary transfer has been, I will not say re-engineered, it is restructured. And one such is what looks like cleaning up, they have actually done it in a different way. Okay. Please look at this. Any transfer of a capital asset by a company to its subsidiary company, the parent company holds the whole of the share capital. That means 100% subsidiary. Then subsidiary should be an Indian company. Nothing shall apply to transfer made after 29th February as stock in trade. This they have included in the main section itself. Not being a stock in trade, transfer of a capital asset by a company to its subsidiary company. Condition. So the date 29 February 1988, it's a very old, so they have removed it. So these kind of, I will say, cleanup, okay, cleanup, re-engineering is not there, it's only restructuring, and unwanted things and all they have removed. Unwanted dates they have removed. Good. And this is one, I've just taken that particular subsection alone for your reference here. This particular law has gone through a wave. Okay. Originally, we were here only. They made an amendment recently, a year back, 2024, that the buyback of shares by an Indian company. So if I pay from a shareholder, if I pay to a shareholder, the entire money what is received by the shareholder will be treated as dividend. Okay, so they amended the 222. So they have included one more subclass called F there, and all these they did. And then what will happen to the cost? I have already invested. So if I invested 1 lakh in shares and the company is buying back from me for 17 lakhs, entire 17 lakhs is dividend. 1 lakh cost, can I not subtract it? No. That becomes your capital loss. Of course, capital loss, if it is a long-term capital loss, you have to only set it off with your long-term capital gain. You cannot set off with your dividend. So, your buyback was actually, the speed was restricted. People didn't found it maybe viable because of this, and same transaction, but two types of head of income it will attract. So now the position has been brought back. So consideration received on buyback will be chargeable to capital gains. So if I buy at 17 lakhs, my cost is 1 lakh. Cost you can subtract. The difference will be treated as long-term capital gain if it is above the 12 months period. Now, here I want to bring one important point. Look at this new subsection 2 in section 69 of the Income Tax Act, what they have brought. They have included additional income tax for promoters. So that means if promoters are stakes have been bought back, they have to pay additional tax rates. So look at this. So that means what is the long-term capital gains tax rate? 12.5. In addition to 12.5, so if you add 12.5 plus 17.5, so it's actually 30%. So non-promoter, okay, so non-promoter, they will be more interested to actually sell in the buyback regime, and more planning will actually happen in this current year. So this is another important change. Actually, while making this amendment, they have also amended 1961 law. So in the current, so what that means for the financial year 25-26 as well as from the tax year 26-27, the position remains. Only for 1 year, the position was previous like this. So this is one important change, but in sync with your 1961 law they have made. This is the first year, I am sure you would have experienced that a budget has come out with amendments in 2 law. 1961 law also they have amended, 2025 law also they have amended, and in 2025 law they have brought 90 plus amendments, and 1961 law they have brought 26 amendments. So there are few amendments which are common to 61 law and 2025 law. So thereby you will see seamless. So meaning your 61 law and 2025 law will never feel different. So that is why that seamless amendments also they have brought it. I will bring before you this one small, is it intentionally they did it or they missed it while drafting? Maybe the wisdom will prevail. I will leave it to the wisdom of the audience here. Please look at this. This is your capital gain account scheme. So whenever I need time to reinvest, so I will not wait, so I will open a capital gain account scheme. Now when I should deposit, okay, when I should invest. So this is one place where I want to bring your kind attention to this. This 263 is the new section under, is a section under the Income Tax Act 2025. The corresponding section is 139. That is your return of income. So return of income 139 is your 263. So 139.1, 263.1. 263.1 is your regular return. Due date is mentioned there. 139.4, belated return timing is mentioned. 263.4, equivalent to that in 2025, belated return time is mentioned. The time is same, whether it is 61 law or 25 law. Now here, please look at the subsection 2 in 82.2, the corresponding section of 54.2. Almost every section you will have the same. If the capital gain referred to in subsection 1, if not used by the assessee to purchase the new asset within 1 year before the date of transfer, or is not utilized for purchase or construction of new asset before filing the return of income under section 263. before filing of return of income under 263 means, because 263 has your normal due date under 263.1, your belated due date under 263.4. Okay. Then the unutilized amount shall be deposited in a specified bank and utilized as per the scheme notified, capital gains account scheme. Such a deposit shall be made not later than the due date applicable under 263.1. So here they have mentioned it very clearly. They have left out there. So meaning, can I consider the investment deadline, okay, of 263 includes belated return, because the deposit deadline is mentioned as 263.1. So this is one, okay, so whenever you interpret, these kind of interpretations will happen. My view, these are all being the first steps we are taking with this 25 Act. I am sure our auditor brain will audit these kind of areas, and we will have these kind of challenges, and I am sure only the time will rest these kind of small anomalies. But my view, it should be, my understanding by reading at this, it should be 263.1, the normal due date. That is a regular due date. Now here, another, actually, while drafting this new law, certain things they could have rested in peace, rather than continuing that, I will not say anomaly, but continuing that pro-revenue attitude in the new law also. Okay. Please look at this. Okay. Especially the inherited father acquired in 2001 and inherited by maybe the son in 2025-26. Sale is on 25-26. Now indexation is, so after inheritance, maybe 2-3 months I have sold. Technically, asset is held only for a few months. So is it short term or long term? So held by the assessee. Now the previous owner's holding period is deemed to be the assessee. So we have this in the various cases in Bombay High Court and Delhi High Court. There, the previous owner's holding period can be considered to be the holding period of the successor. But the section is silent with respect to that. So these are all the places where the re-engineering could have been brought, but it will be pro-assessee, not pro-revenue. So maybe the advice or the direction towards bringing a new income tax act is, it should be pro-revenue and more simplified, more rationalized, okay, wherever the need for unwanted things they have to remove. So rationalization they have done, simplification they have done, but these places could have also been done. Now please look at this. These are the connect between your the tax rates. So your 112 tax on long-term capital gains, which is the special rate, the equivalent of that is 197, okay, long-term capital gains. So look at the English here, okay, between 48 second proviso and 72 2. So actually there is no word called proviso in the new Income Tax Act. So where long-term capital gain arises from transfer which takes place before 23rd July of a long-term capital assets, provisions of clause 2 shall have effect as if the cost of acquisition can be substituted by index cost of acquisition. So that means indexation is applicable for the computation purpose, and in case the tax is higher for the normal 12.5%, the excess has to be ignored. So that is the logic they have brought here. Same they have retained there, but the English they have made it very simple. Okay. In the case of an individual or HUF being resident, and in the case of transfer of a long-term capital asset, very specifically land, building or both, which was acquired before 23rd July, excess income tax shall be ignored. So the English is not as complicated. Please look at tax computer under item B, item A minus B, then should be ignored. So all those, so the complications has been removed. Actually, I am reminded of, I'll take you to one more because I'm here. I'll take you to this property. Actually, these are the two definitions I want to bring before you. Okay, because you were the moment you go to a charging section, transfer of a capital asset. So your capital asset is actually 214 and transfer is your 247. So instead of 247, it is now 2109. Okay, so that is transfer definition. And instead of 214, it is 222. 222 is your capital asset definition. Same will be there. So I'm just taking two terminologies, property definition from these two. Property includes any rights. Includes, it's an inclusive definition. 92 5F, actually till 91 is capital gains. 92 is other sources. In other sources, subsection 5 has definitions A, B, C, D, E, F. F is actually your property. So there means the following capital asset of the assessee. So there they list out what a property means. Immovable property, shares, jewelry, archaeological, drawing, painting, sculpture. So the very big list they give. And in capital asset definition, they include right also. Because here it is a means definition. So means it is exhaustive. Only 10 items. Now what if you have rights on a particular asset? Okay, including any rights in or in relation to an Indian company, including rights of management or control or any other rights. Any other rights. So it's actually very, very wide. So property includes. So quite a very wide definition is this part. I want to bring before you the immovable property definition. Okay. Actually, this is in the 1961 Act, immovable property is not defined in section 2. Immovable property, you have to go to 269 UA. UA, capital UA. Actually, that section is not in practice, but it is there in the book. Because some of the procedures are referred, some of the definitions live. And they have lifted that definition. 269 UA F definition they have lifted and they have kept in 2109 transfer. So in transfer, the only place where the expression immovable property means. So this is not an explanation. This forms part of the definition. So A, land, building are part of a building and includes machineries, plant, furniture, fitting. Rights. So that is the reason, because in immovable property they mention about rights. So in capital asset, they have also want to bring property includes rights. So here also they have mentioned it because it is immovable property and sometimes an access rights. Rights with respect to any land, building, part of a building which has been constructed or yet to be constructed, accruing, arising from any transaction. So, right, you go to Bombay, you go to Gujarat, ownership title deed will not be there. But only the membership of a society will be there. So, through that the ownership of an immovable property will be established. So, quite India is a very, not only we are geographically spread by culture, tradition, practices and language, but also by these kind of business practices also. Now I'll take you to Madam, you have to tell me when I should stop. Okay. I will now, this is another interesting place. If you look at this, actually they have not changed anything. So only the explanation alone, okay. So please look at the English. It's almost same. So it is explanation 3 and 4. That is actually 72, 2B and C. What is the indexed cost of acquisition? So it is as such same. So only what was an explanation, now it is a subsection. Good. Now here, again a complicated section has been broken and given in 2 separate points. They have broken it and given in 2 separate points. Please look at this. In notwithstanding anything, this is actually whenever a depreciable asset and your block will have a value, but the asset is sold. So that means only in the book you have some value, but physically asset is not there. Then what to do? So they give the procedure. Okay. Notwithstanding anything contained in 242A, where any block cease to exist. So there they divide this into 2 parts. One, cost of acquisition shall be written down value plus as increased by the any asset that has been brought minus the income received will be treated as your capital gain. So they have given a presentable, I'll say restructured only, so no re-engineering here. Good. Here look at the wordings. Actually your 54F, 54EC, all that, the wordings will be, it will start with a different term. Look at the wording. If an individual or an HUF has capital gains arising from transfer of any long-term capital asset, not being a residential house, original asset. This bracket has been new. Actually, even for that matter, there are many places where they have brought bracket. If you go to a relative definition, normally relative means father, mother, okay. So left hand side is your spouse, right hand side is your brother, sister, and bottom is your children, son or daughter, or grandson, granddaughter. Now, that relative definition will only speak about lineal ascendant or descendant. That is 1961 law. But in the new 2025 Act, they have made a slight change. So they say lineal ascendant or descendant within bracket paternal and maternal. So this bracket they have used, the parenthesis, usage of parenthesis actually widens the definition as far as relative definition is concerned. Here, either it widens or it pinpoints, okay, this is the particular asset for which you are actually going to do. So whenever they are going to make any reference, so in the section, they will say original asset. Why? Because while going through this section 54F, you will come across, because even as a student days we used to have this. Sir, here they say a house. Now you have to buy a new house, residential house, which should be the, so that means at the time of disposal, he should be owner of only one house. So then what will happen to the original? So that original asset, in addition to that, he was having another house property and he is eligible to reinvest. So he sells this property and reinvest. So therefore, this original asset to pinpoint, other than the original asset, he was holding another asset. So that part, they have brought a clarity. So I'll say this is not simplification, this comes under rationalization. So to make the reader clear rather than getting interpretation or opinion from the professionals. So these are the other equivalent definition part, just for reference I have given. Actually, this is another place where they could have given a clarity. In the name of re-engineering, only restructuring is done. Now, I'll take a simple example. Please look at this. Actual sale consideration 1 crore. Okay. Stamp duty value, this is actually 86. Section 86, reinvestment exemption. Stamp duty value is 1.5 crore. Cost of acquisition 30 crore. So, because of your the 50C implementation, you take the 1.5 crore as your deemed consideration. So 1.5 minus 30 lakhs is 1.2 crore is your long-term capital gains. Now you reinvest in residential property 1 crore because your actual sale consideration is only 1 crore. Now, what is net consideration for reinvestment? Because deemed consideration is 1.5, okay? Because this is where the controversy is there. Actual consideration is 1 crore. So section 78 deems stamp duty value as full consideration for capital gains computation only. It does not on its face travel to the exemption section. Section 86(10), okay, subclass 10 defines net consideration worded to word as old 54F. Explanation did. That's it. So this is one place where they could have actually given a more clarity. Again, we have to take the help of case laws only. Okay. So apart from this, these are some of the significant points which I want to bring before you. Now, I want to take you to another part of the session. Now, before I take you to the other part of the session, I want to share with you a small anecdote. If a girl or a woman, okay, she listens to you, starts to listen to you, but after 5 minutes she gets bored. She says, no, I can't listen to more than 5 minutes. Definitely, she is your daughter. But if a woman listens to you maybe maximum 10 minutes or 15 minutes, beyond that she couldn't pay attention, definitely she must be your sister. And there is a woman who has been paying attention to you, and even after 30 minutes also, she has been very patiently, okay, what next? Okay. So then, if such a patience she is having, whatever may be the boring lecture you have been giving, then definitely she must be your mother. Okay. Now, there is one lady, you have been speaking so much time, she pretends as though she listens. And she doesn't remember not even a single thing what you say. Okay. Then she must be some guest should be there. Why you are bringing wife every time? Since she can't, she must be deaf. Okay. So, but I am fortunate to have this much audience to be very focused and attentive post lunch after the wonderful lunch given by our chairman. Okay, good. Now, this is one area they have tried their best to. They have tried their best. So, we must really appreciate the people, the team behind, because hours, thousands of hours they have spent. But what they have done, you have this section which starts in 194, because 194 is one section which will have so much subsections. Okay, so it will start with A, B, C, D. Okay, so many. This entire TDS, they have so much of subsections. They made it into a tabular form. And I still remember when the international tax subject, whenever there is an international tax related analysis we have to do, non-resident related TDS. So which section is applicable for resident, which section is not applicable for non-resident. So that is one place where you have to buy a TDS book. Okay, income tax book, you have to buy a TDS book. Okay. Quite and then you have to read, okay, this section. And especially firms which do more on advisory, more on giving opinions, they used to have a field day, because only giving opinions for 1 page or 2 page, they used to make good money. Now, the entire subject is now shrunk and they have given it in a tabular form. So this is one way good. So they have only given 4 tables. For resident 1 table, for non-resident 1 table, for other persons, they say it is other income. Mostly those others is you are winning from lotteries, so card games, so like that alone is there. And another table is when DD is not applicable. I like that table. So where every section where the exceptions are given, that they have collected and they have put it in one table. Quite interesting. That section, I am sure even at midnight, 12 o'clock, if I make you get up, please tell me the section number for TDS, then you sleep. It is very simple. It is actually a section number called 393. Okay, 393. So 3 cube is 9. So very easy to remember. I will only now take you through some of the interesting questions which will emanate from TDS. And then we'll have some discussions, maybe questions. I don't know whether it is visible. I don't know whether it will be visible. You have to go down. Right. I'll take, Aram say, please take these questions. Maybe as a, I'll recommend you to go through these questions because these are already there in the, this is shared by the Income Tax Department. There are obligations up to 31st March 2026, but the payment are made after 31st March 2026. Which law will apply? Which form will apply? There are many questions that emanate. no, new forms are not there, what to do? So actually the new forms is applicable. Of course, tax payment challan alone, they have made a change. They used to ask a question, should I have to use an old tax challan form or a new tax challan form? Actually, the new tax challan form is only applicable for taxes to be paid for the current tax year. So whenever the transaction pertains to, income pertains to the current tax year, because we are not supposed to use a terminology henceforth called as previous year or financial year. It is only called as tax year. Now, what is the fundamental rule for determining which act governs TDS obligation during that transition? Act governing TDS when the earlier of the event of credit or payment occurs. So this is where, for example, the accrual of salary, maybe salary is paid in the month of April, but it is accrued in the month of the March. Naturally, what is accrued is March. So which law will be applicable? It is only the 1961 law. So this is one area we need to have some idea. If a deductor has an ongoing contract with monthly payments, how does deductor handle the switch from the old act to the new act? Especially monthly professional fees and all this stuff. So this is one place where, of course, if you look at the TDS provisions, the rate change is not there, the limit change is not there, only the structural change is there. I repeat again, 1961 law, 2025 law. Do you have a rate change just because the law has changed? No. Limit change? No. Then what has actually changed? Only the section number, structural change with respect to the presentation of the provisions. That is the only change. So therefore, the deductor applies the old act for all payments or credits up to 31st March. Will apply the new act for all the payments of credit from 1st of April 2026. So system is very clear, but this is one place where in current year we will have a challenge. Not only us, clients will have a challenge whenever they make the payment, because they have to choose the right assessment year. Because from 26-27, because this is 1 year where you will have a tax year 26-27 payments also, and assessment year 26-27 payments also. Assessment year 26-27 TDS payments which you have to make now and maybe file the TDS return. And for the 26-27 tax year, we may have to deduct the tax maybe for the first Q1 and pay the taxes. So these are the places where we have to be a little careful, because this is the first year and the final year. From next year onwards, it will be smooth for us, because it is only tax year 26-27, 27-28. So next year it will be tax year 27-28, and the previous year we will only call it as tax year 26-27, because there is only one name for that. There is no two names for it. So the clarity will be very clear. And this is this 1 year where people who are actually making the payment, better to document, make it very clear which previous year it belongs to, which assessment year it belongs to, which challan, and then make the payment. Sometimes if the payment is made wrong, this is one place where I want to bring your kind attention, an RBI notification. An RBI notification which came recently, just 10 or 15 days back. Maybe I would have given that reference also. That notification speaks about, in case you have made a wrong transfer, whether it is NEFT or RTGS, please inform your particular banker before a particular time. So they have mentioned in few hours. So maybe before the end of the day. Then the transaction can be reversed. Okay. So this is a RBI notification. So I wish, please download that notification and keep it with you. What is that window time? So in case any wrong payment has been done, you can escalate to the respective bank's HO, and there at the server level, they will actually reverse the transaction if the transaction has not crossed the window time. So for the current year, it will be very, very helpful, especially if the amount is huge. Go. Has there been any change in the rates of TDS? No change. Okay. So therefore, actually it is a seamless transfer. Whether it is 1961 Act or 2025 Act, seamless transfer. So no category for all category of payments. So including the limits. So above 60,000, above, okay, monthly, the rent is above 1,80,000. So all those limits also has not been changed. It is same. Please go to the next one. What happens if a deductor erroneously deducts, very important, deducts TDS quoting the old Act section number for a payment made after 1/4/2026. Okay. Although the substantive, these are the places where the form itself should not permit, because the moment you select the tax year, the new section only should be in the drop down. Okay. Although the substantive provision such as applicable rate remains unchanged, citing the old section number, okay, may lead to processing errors. Actually, this is one place where our institute has already made a request. Also, the Bombay Chartered Accountants Society also has made one request parallelly that in the portal they should facilitate. Once the assessment year is selected pertaining to 1961 or the tax year is selected, the respective section only should come rather than permitting the assessee or the assessee's representative to type the respective section number. So this was one. So deductor may be required to submit a correction statement to rectify the section reference. Okay. Of course, if in the new law a wrong section is taken, nevertheless you can go for a rectification. What if? So the same procedure only. Good. A company makes payment to a contractor on 28th March. Which act governs TDS in this situation? So it is sometimes the payment or accrual, whichever is earlier. Maybe an April related payment, advance is given or a payment is given earlier. TDS provision of 61 only shall apply, since the triggering event payment or credit is earlier. So your accounting record, payment record is very critical. So therefore, the current year tax audit, maybe it's a little early, but not too early. Your current year tax audit, actually, we were, in my office, we did one small exercise. Compared to last year tax audit, current year tax audit, what will be the normal time it will take? Time sheet, estimated time sheet it will take to verify the transaction if the same quantum of transaction happens or volume is there. To my surprise, we have to actually do some additional checking, and till the current year tax audit report format has not been analyzed much in greater detail, and we have to even receive the guidance note also. So current year tax audit, maybe this will be the last year of tax audit under 1961, but we need to ensure that the payments pertaining to the next year has to be carefully handled. Interest income is credited in the account of payee on 31st March 2026, but paid in April 2026. Which act will govern TDS? So accrual basis is 31st March. So 1961 law only will apply. Are tax deductors required to modify their ERP and payroll systems after commencement of the Income Tax Act 2025? My view answer is yes, because section numbers will change. Number two, you also have the new wage code applicable from 1st of April 2026, subject to the rules to be notified by the respective state government. So therefore, the ERP and the payroll systems have to update themselves with respect to the new Income Tax Act. So these things doesn't change. Okay. So same 7th, 30th and all this will remain. If the tax was deposited in March 2026, but the deposit is made, deducted in March 26, deposited on May 2026, will there be late deposit consequence? Answer is yes. So, because the law pertains to that is 1961 law, so your 1961 law provisions will apply. So it will take time for us to actually get these forms registered in our mind. So form number 138, form number 140, instead of 24Q and 26Q. So all these English, all these have gone. You only have a numerical form now, as of now. As of now, numerical form. So maybe 1 year it will take for us to get ourselves accustomed to these form numbers. Your ETDS return preparation utility, will it support both old and new formats? Naturally, yes. The government is ensuring that the return preparation utility supports both the old format returns and the new form returns. Okay. So you will have a separate RPU for that. So you have to be very careful which utility you are using. So there they will mention very clearly, this is for Q1 tax year 26-27 utility. So correct utility we have to use. Normally we will have it in our ICAI exam. In ICAI exam, there is one concept called when you run the software for processing, the application for processing, the correct version control, I repeat version control. So there will be version 2, version 3, version 4. So the latest version I should apply to get the proper output. So up to my 31st March, that means Q4, for Q4 of 25-26 financial year, I must use the RPU pertaining to Q4. The Q1 of tax year 26-27, I must use the respective RPU. So therefore, while downloading that respective RPU, you have to be very careful. Okay. So which version? So wrong version should not be used for processing. This is one place where maybe we have to train our people, and maybe before the data gets uploaded, especially for Q1. So we are actually now in June. Our Q1 obligation will start in July. So at that time we have to be careful with this, because it will be an updated RPU. If a deductor discovers an error in a TDS return for 25-26 Q3, that is your quarter 3 of the previous year, can a correction be filed after 1/4/2026? Answer is yes. Same process will continue. Nothing wrong. Will revised or corrected TDS returns for period prior to 31/3/2026 be filed under the old or new act? Okay. Actually, it should be filed under the old act. Revised or corrected TDS for periods prior to 31/3/2026. Even though those returns are filed in current year, that is 26-27, it belongs to 1961 law only. Okay. Good. This is one important question, actually. I'm sure everyone will have it. Please look at this. If a deductor fails to issue 16A for Q4 of 25-26 within the due date, which act governs the penalty? It's 1961 law. Okay? And the 272A 2G of the old act. I'll only give a one-line connect. I'm sure all of you will agree with me. Transactions pertaining till 31(3), old law will prevail. So TDS returns, amendment TDS returns, edit of your TDS returns, old law will prevail. So for your current Q1, your tax year 26-27, your new Income Tax Act will apply, and your new tax payment challan will apply, and all the equivalent forms, that is that 138, 140, so those forms only will apply equivalent to that. So technically, if you look at the forms, is there any change? Is there? Actually many change. Maybe we need a much bigger forum to actually analyze form by form. Lot of changes has been brought out with respect to in the usage of the form. I am sure by this time you would have experienced at least few such instances, especially in PAN form, because already we are on the third month. You would have experienced the change in the PAN form, because there are 4 types of PAN forms instead of one PAN, and there is a necessity to give a proof for date of birth, and so many things have actually. So therefore, your section has not changed with respect to PAN, your rule has not changed with respect to PAN, but the form has changed. So, and if you take the rule and the forms, in the old form, what was there as instructions, they have cut and pasted in the rule in the current income tax rules. So to that extent, changes has been brought. So being a conference session, I only brought the highlights before you, but the finer points, for example, form by form. So if it is a 140 form or your equivalent of 26Q, so form by form comparison, if I show you parallelly, you will see quite a substantial change. I want to bring before you one interesting fact here. The website has come out with form and also the instructions to fill a particular form, and also an FAQ with respect to a form. These are all new actually. Now, is it required? Maybe just take only one form to understand the reason, because the contents of the form they have actually updated substantially. Maybe if at all I have been under the impression that no, the 1961 form, okay, in the conference he made one remark, rates have not changed. The section, even certain cosmetic change, wherever it is pro-revenue, they have done some re-engineering. If it is pro-assessee, they have not done anything. So limits are not changed, rates have not changed. Section-wise, the changes are very, very minor level. But at rule level, the changes are, I will say, the percentage change is 40% to 60%. 40% to 60% change you can see at the rule level. At the section level, maybe 5% change to 10% change. So you may not see much difference at the act level. Of course, I have shown you the difference. So you drill down to rule, substantial change you can see with respect to the procedures. So this Q1, my suggestion, please have, in my office I'll just share with you the process which I have changed, especially past 1 month. We used to have a training session weekly once. Now what I have done, I have made it mandatory that there will be training session daily. Daily morning 8:30 to 9:30, people have to come and one among the participants they have to present. What they have to present? Section they need not present. Rule, form. Form and rule. Comparison between the old form, new form. Right from ITR. But of course in ITR we have to only wait for 1 more year for the tax year 26-27. This will be the last year for your ITR 1, 2, 3, 4, 5, 6, 7 for assessment year 26-27. But your forms have made a substantial change. So, and the respect to rules. So forms have a connect to the rules. So there are certain rules are quite voluminous. The content of the rule cannot even be compared with the previous rules. So a lot of changes have been made. So every form you will feel as though the form is totally new. And it requires continuous training, especially in every office. Every CA who actually into compliance practice, the need to actually understand the FAQ. And what I understand is, especially when ITR has been brought out, we used to compare the previous year ITR and current year ITR, come with the differences. But forms alone, we took a stand that we will not compare old form with the new form. Old form is with respect to up to 31st March. If transactions pertain to previous year 25-26, use the old form. Transaction pertains to tax year 26-27, take new form, read the FAQ new, go as though it is a new form. Please don't compare. Because by comparison, you get lost. That is my observation and my limited experience with that. So we used to go to the form as though the form is a new form. Please approach it as a new form. The FAQs and the instructions for filling the form are so detailed. We took the form printout and made a spiral, and we also took the instructions and made a spiral, which is so bulkier than that. That much of detail they have given, and that itself is sufficient for us to have an understanding. So friends, before I leave the floor open for questions, there was a son who actually asked a question to his father. Dad, I have a question. So it was Treta Yuga. Lord Rama listened to his father. Therefore he was great and he attained the godly status. And in Satya Yuga, Bhakta Prahalada, he did not listen to his father. Thereby he was also considered great. Now this is Kali Yuga. Tell me, Dad, whether like Lord Rama, I should listen to you, or like Bhakta Prahalada, I shouldn't listen to you. For that the dad said, Dad, son, it's a very good question. In the interest of both of us and for harmony in the family, it will be best if we both listen to your mother. Very similar to that, our mother is our Honorable Finance Minister. So whatever laws and rules that has been brought out, I'm sure this year will be more of CPE programs, actually to give you a comfort and direction. My one-line observation about the new income tax act I'll give. You need not worry that it is a new subject. Number one. So that means the good news is, it is not a new subject. Another news is, it is not a bad news, but the subject has matured, especially at the practice level. So, meaning rule level and the form level, they have made substantial changes. They have made substantial changes. I'll give you one small tip. Next year we will have the new ITR for the 26-27. You please go to section 263 of the new income tax act about return of income. In that they have made it very clear. In the return of income, assessee should give the bank details. It all started with one bank account because the refund has to be credited. Then they said you add all the bank accounts. So today, all bank accounts are, you are informing in the return of income. What happened to credit card? So far, we are not giving any credit card details. But at the back end, government has the data. A guy has actually filed a return of income for 12 lakhs. Of course, current year up to 12 lakhs, you don't have a tax also. Maybe till last year or before he pays some few thousands as tax. But his credit card, he spends minimum 1.5 lakhs per month to 2.5 lakhs or 3 lakhs. So his total credit card payments is actually 25 lakhs for 1 year. So his expenses is 25 lakhs, which is available with the government of India. But the income is only 12 lakhs. This is actually a visible information, an authentic information available with the government. Now, in the new income tax, so that means you cannot compare this with the 1961 law. So what they have done, in the ITR, in the income tax return, after the bank account, credit card numbers also has to be given. I repeat, credit card number. So credit card number only has to be given. What is the total payments you have made in a credit card? Will they ask or not? As of now, Act is silent. Rule is also silent. ITR forms is not yet notified for new Income Tax Act 2025, which will only come in April 27 only. So, but credit card information is mandatory. So, if you ask a question, what is the fundamental difference between your old forms and new forms? Lot of difference. One small change will bring lot of repercussions in the way the disclosures are made. So, Act may not look that much change, here and there small change, okay, maybe 5%. Rule-wise, substantial change. Form-wise, you will see a complete changeover. So, and the objective of Income Tax Department, when Madam Honorable FM, she made the past 3 or 4 budget speeches, she made this remark that we are moving towards a digital era. Law will be made simplified and rationalized. And we are going to make it, that means pre-filled tax returns. I repeat, pre-filled tax returns. You already have AAS with you, 26 AAS with you. Currently, we reconcile the 26 AAS and then again we fill up. So, it is only a redoing of a data. Can't this data be pre-filled directly? To some extent, it can be pre-filled. My view, 26-27 tax year return of income will be the first return of income where pre-filled income tax return will be available. You have to download it, accept partly accept, reject. So like this, like how you have in GST. So maybe you have to do that. And wherever you give the deductions, claim deductions, proof available, not available. Available means, not available means they will reject it. Proof available, possibility that they may, out of 10, out of 100, 2 or 3 may be selected. You already said proof is available, submit the proof. Otherwise, deduction will be withdrawn. So the forms will be more transparent. Forms will be more in an accountable manner. That is how the forms I am looking forward. So the way the forms have been actually structured, it is total re-engineering. It is not even restructuring. Total re-engineering, revamping, and actual learning doesn't start with the act. Learning actually starts with the rules. I mean, rules and the forms. So that's my humble learnings from this new Income Tax Act 2025. So I must thank Kozhikode branch for this wonderful opportunity. It is actually a yogam for me to, a blessing to again come back to present here. I am reminded of the difference between the term called yoga and yogam. Somebody asked a very senior person, sir, what is the difference between yoga and yogam? Very simple. If your mind is calm, you are calm, it is called yoga. If your wife is calm, then it is yogam. Okay. If your wife and mother both are calm, it is amogam. And if both are not calm, it is yamalogam. Thank you very much, friends.
Thank you, sir, for that.
Ladies and gentlemen, we are ready for the question and answer session. Please raise your hands and the mic will be given to you.
My name is Venugopal. Venugopal.
Yes, sir.
There is a large piece of land, say about 1 acre. And on the corner there is a residential house. The entire plot is sold. Can we claim under 54 and 54F both? I mean the pertinent land under 54 and the rest of the land, which is huge in area, that can be claimed under 54F exemption?
Okay, it is not subdivided.
No.
The document is not 2.
No.
So there is a possibility of a litigation if you claim both. Yes. Because how do you identify that this part is property income, this part is land income?
No,
so some base document, maybe my suggestion is before you sell, divide. You can actually go and make a subdivision of the land. If you make a subdivision of the land, my view is that portion alone, you make one document, sale document. The other portion, you will make a second sale document. My view, you are eligible for 54F for the land portion.
The Act doesn't prohibit claiming under both the sections.
Sir?
The Act doesn't prohibit claiming under both the sections.
No, it doesn't prohibit.
Under which section? No.
It doesn't prohibit. But you have one interesting provision, and because 54 makes a clear point that it should be a residential house.
Right.
So land with the residential house Because if you read the provision, it says land or building or both. So therefore, 54 will be eligible for full piece, including land and building. But 54F, they make it very clear, other than residential house.
That's why. So we can take the appurtenant land for the use of that building.
How do you do it is the question.
No, that is only a question of fact. When many cases, questions of facts are decided, on the basis of an argument.
That fact is, you have to divide it.
No, but in principle, is it possible?
Possible.
On fact, I agree with
Definitely possible. I agree with you. But better to go for a subdivision. May not cost much.
The transaction is already over when they come to us.
You may invite litigation, but possibility is there.
We have to choose one way or other when we file the return. What's the best choice?
Sir, if I am the assessing officer, I'll put a simple question. What is the question? How do you distinguish the total sale consideration for land and residential house separately? This is a simple question.
No, that is given in the document. The value of the house, sale value of the house, because according to the new rules of registration, you have to give the building value separate and the land value separate.
Maybe if your sale deed is very transparent like that.
No, that is a rule under the Registration Act. You have to separate the...
Yeah, I'm clear. In the annexure you are making it.
Correct. So
But possibly, because it is indivisible, I may take a stand that it is only one property, residential. That is why I said, you may win in litigation, but it will be litigated.
No,
Possibly.
That's not correct, because so much of land you won't use for a small building.
I agree with you, sir. But this possibility is there. Thank you.
Thank you.
Thank you, sir. May I request CA Albhuda Jyoti M, Chairperson, and CA Ravi Chandrasekhar, Secretary, to join Dr. May I request all the members of the Managing Committee to join us on the dais. Thank you, sir. I now invite CA Ravi Chandrasekhar, Secretary, Kozhikode Branch. Before the vote of thanks, may I request the session chair, CA Rasha Abdur Razak, to honor CA Gopal Krishna Raju with a memento as a token of our respect and gratitude. Thank you, ma'am.
It's indeed an opportunity, I would say, I have got to gift to my guru, because latest I was doing a DISA course and I am his student. So I'm very happy on this occasion that I was able to give a token of love from the Kozhikode branch to my guru itself. Thank you. And we look forward for such sessions onwards. Thank you, sir, once again.
I now invite CA Ravi Chandrasekhar, Secretary, Kozhikode Branch, to propose the vote of thanks.
Chairman CA Albhuda Jyoti, Vice Chairman Vinod, afternoon faculty Sri CA Gopal Krishna Raju, Treasurer Thangachan, and Sikasa member, Rasha Abdur Razak, senior members, past chairmans, other members, it's time to say thank to whoever has made this grand event a big success. Last 2 days has been very hectic for us. With too many things we had to include in such a short period of time, we had to cover a lot of areas. I think we have made full justice to this, whatever we plan to do. So I want to thank all those persons who have made this thing possible. Yesterday, we started the session with our morning session with the CAT Bhanushekar, who talked about representations before appellate authorities and points to consider before choosing writs. So you all will agree with me that he did an excellent job. And I want to thank him on behalf of Calicut branch of ICAI with the whole heart. Session 2, which was inaugural session, we had Abdul Samad Madani, MP from Panani, then CA Chandrasekhar Vasan Chitale, Taxation Committee Chairman, then CA Jay Charia. I want to thank each one of them for their presence and for making that event a big success. After that, the evening we had CA Ajit Shivadas from Palghat, who talked about taxation of firms and potential challenges. He could engage and keep our audience engaged for 2 hours with his talk. And on behalf of ICAI Calicut branch, I thank him wholeheartedly. The morning started with CA Rishabh Agarwal. He talked about navigating the changing landscape of statutory updates, policy shifts, and systematic overhauls. And I want to thank him for in-depth analysis of that subject. Then in the second session of the day was handled by Sri V. Ramnath. He talked about exemptions under IT Act. And within that short time of 1.5 hours, he covered a lot of subject. And it was a wonderful session. And I want to thank him on behalf of our Calicut branch. Of course, we know that we had last 2 hours spellbound by CA Gopal Krishna Raju, capital gains and tedious provisions. And on behalf of Calicut branch, we thank you, sir, for your presence and for your session. And I want to thank all audience, all the persons present in the audience for being here with us and sharing the 2 days program and making this a big success. Thank you. I want to thank the sponsors also who made this event, helped us in a big way. And I want to thank the persons who have worked behind it, the hotel management, etc. Thank you.
Thank you, sir. Ladies and gentlemen, as we conclude this national conference, we reflect on 2 days of meaningful learning, insightful deliberations, and professional enrichment. Our sincere gratitude to all speakers, delegates, sponsors, volunteers, and organizers who have contributed to the success of this event. May the discussions over these past 2 days help us navigate this transition. I request everyone to rise for the national anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जनगण मङ्गलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you everyone. Safe journey home. Jai Hind.